Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's Friday, finally Friday. We are coming to you from the CNBC-TV18 Motilal Oswal studios. Slightly brighter smiles, I noticed. So, Ruby and Nigel. Morning.
Yeah.
Absolutely. It's a Friday. That's reason in itself, right, for bright smiles. Not that the market has really found its direction. It's just been a full week of consolidation. But as always, plenty of earnings, news, updates to handle.
Well, it's going to be earnings from here on. And we're getting a mixed picture out of there. And next week, I think we go full throttle out there. So enjoy the Friday, enjoy the long weekend, and come back for more. Prashant, let's get
throttle into what?
Into earnings.
He's already talking about next week. I mean, I don't know. Is optimism, pessimism, what?
That's what.
That's the right philosophy. You know, just look through the weekend. It doesn't exist. Then it feels better.
No. I'm in my pink polka dots. I differ from both of you guys.
All right. Well, U.S. markets had a positive session last night. And you basically have the S&P. Actually, markets are inching back towards all-time highs, led by, of course, what happened on the Russell 2000. The Russell was the best performing index as a small cap index, 1.25%. But look at the other changes. NASDAQ, 0.75%. The S&P, about 0.5% gain as well. I mean, this rally essentially on the back of this kind of sort of almost, and I hate to use the term, but well, it kind of fits this time, is the Goldilocks macro environment. What is that environment? There you go. It's basically strong U.S. retail sales. Actually, there are about 4 data points. I'm only mentioning 2, the most important. But strong U.S. retail sales, 1. And the second one, low weekly jobless claims. Essentially tells you that the U.S. consumer is looking pretty good. And the U.S. economy is pretty good. So, when we kind of ask this question, why is the trade uncertainty, trade-related headlines, tariff-related headlines and uncertainties at all-time high, but you also have the S&P, which is at all-time high, so it doesn't square. I think the answer lies here. The economy is so solid in the U.S. So far, it's been able to absorb these higher tariff rates, whatever has happened so far, that it's not showing up. And that's the reason why markets are not paying attention to all these sort of, headlines as well. The 10-year was unchanged. The yields were unchanged, about 4.46. Dollar index up a little bit, but nothing very much, 98.5. I've been saying that oil prices have been bouncing around 66, 68 to about 70. So they were up about 1.5% back to about $69.5. There was one report which came through as U.S. markets were in the last 2 hours of trade that U.S. is set to impose a 93.5% tariff on Chinese imports of graphite. But a final ruling should be announced by the 5th of December. So we'll see if this does go through. But I mean, you've got a couple of graphite listed stocks here, HEG, graphite, etc. So we can talk about this in a bit. Reports of a potential Scott Bessent, U.S. Treasury Secretary, and Japanese PM meeting that is on Friday. And by the way, I mean, President Trump essentially said that he thinks there are about 5 or 6 deals which are still in the works. Guess what? I mean, which perhaps should be done before the 1st of August deadline. And India and South Korea are top of the list in that sense. I mean, he's basically specifically called out India, saying that we're very, very close. This was Wednesday evening. So we're still in wait-and-watch mode, but it could come. We'll see. The levels don't change very much. Yesterday, you had a down day. The Nifty was down 0.4%, as you can see up on your screen. But the low, I would still sort of say, which we've been saying is the low over the last 4-5 days, 25,001. I mean, that did not get breached, and that remains a support. I've just included one more resistance because the market's been down, which is the recent high of 25,255, and then 25,400, which is the 61.8% retracement. For the Bank Nifty, I mean, you've got the resistance levels, again, I mean, just added since the market's been slipping a little bit, 56,937, recent high, and then the retracement, which is 57,628. Support here comes in at 56,594, which does not change. I mean, the lower bounds have not broken yet, which we saw over the last 4-5 days. And I think only then you'd kind of sort of start to project slightly more downish kind of levels. GIFT Nifty, I think, is indicating a flattish start and should give you a quick sense. 10 points this Friday morning. Surbhi.
Well, absolutely, Prashant. I guess, markets have managed to look so well through all the tariff headlines noise and the political noise. By the way, the Jeffrey Epstein file, the reports that they finally might be released. So there's a huge amount of political noise as well in the US. But the market has completely looked past that because of solid earnings in this week, whether it's the big banks like JP Morgan, Goldman Sachs, etc., or, a lot of other names as well. We've got pretty solid earnings that have come through. Now, Asia is tracking a lot of that Wall Street optimism this morning. Actually, most markets are in positive territory. Taiwan, Hong Kong, mainland China. The Australian market hit a fresh high today. Japan is flashing a little bit of red. It started positive, but there's some profit booking that's come in. Though, actually, the inflation data in Japan is pretty good. Because the headline inflation has come down, the core inflation has come down. Headline has come down from 3.5% in May to 3.3%. Core has come down from 3.7% in May to 3.3%. So inflation is generally softer, but we're seeing some profit booking out there. So the short point is global markets are holding up, but we've had an India-specific issue. It's been a complete consolidation this week so far. If you look at the last five trading sessions, the Nifty has been grappling with a 0.5% to about a 1% decline. If you look at the last 1 month itself, I mean, it's not just a 4 or 5 day odd consolidation patch. Then at the headline index level, we just haven't moved about 1% higher. I want to point out the FPI flows for the first time so far this year, or actually not for the first time. For the first time since we had the rally, since the April lows, flows have turned negative. So far in July, net inflows are down 2,660 odd crores. And that shows up on the daily data that we talk about. Even yesterday, for instance, we had a decent amount of FPI selling, almost 3,700 crores of FPI selling in the cash market. It was offset to an extent by 2,800 crores of DII buying. So the lack of foreign flows is definitely a bit of a hurdle that we've been facing. As usual, it's all about earnings, and we'll talk about this as we go forward as well. Today, Axis Bank is going to be in very, very sharp focus. Now, this technical impact that the bank is speaking about, will the market take it as a positive that the bank is showing extreme prudence? Not that the regulation required it, but it itself is looking at a tighter way of recognizing NPAs. We'll have to see how that debate plays out, but that surge in slippages, 8,200 crores of slippages, it came out of the blue. The bank is also saying that this is a 1 quarter off. They've recognized everything with this new phenomena in this quarter, the entire book. So let's see if the market is willing to give Axis Bank the benefit of doubt. But otherwise, the numbers are really, really disappointing. Even growth, even margins, everything's come under pressure. Wipro has been a mixed quarter. Constant currency growth is down 2%. But again, the good thing with Wipro is that the deal pipeline is looking very, very strong. Their deal win track record is very strong for the quarter. So again, it's a nice debate whether the bulls will have it or the bears will have it on Wipro. LTIMindtree at least has some growth. I mean, one company that's reported at least 0.8% constant currency growth. So LTIMindtree is actually not that bad. And Indian Hotels is doing so well. So even in this earnings cloud, you have bright sparks like Indian Hotels. I mean, look at this, profit up 20%, revenues up 31%, EBITDA's higher in a quarter where we had a lot of geopolitical tensions, Operation Sindoor, flight disruptions, but yet they've managed a pretty decent show. So, by the way, today's result calendar, let's not forget, today's Reliance Industries, JSW Steel, there's L&T Finance, Bandhan Bank, Hindustan Zinc, just a few names, the long, long list. So, yeah, Nigel, I completely concur with you. It's going to be earnings, and more earnings.
Well, that's right. Earnings going to pick up the next 1 month or so. It's going to be action-packed. And, the markets, it seems, we're missing that positive trigger. Because in the month of July itself, the Indian markets actually have underperformed. If you compare the Nifty with the Shanghai market, that's just for the month of July itself. We're relative underperformance. Even if you compare to the US markets, well, we're relatively underperforming. Nothing really to worry. The problem is we're lacking that positive trigger. And since everyone's bracing for these weakish, subdued first quarter earnings and then looking at quarter two to see a pickup, I guess the market's lacking that positive trigger, which could very well start playing out from August itself. But July so far has been a bit of a dampener. But I say I'm not too worried. And that's because if there was fear in the system, you would have seen the VIX that would have spiked up. Now, though we have seen a bit of a pullback, the VIX still, on a day-to-day basis, it doesn't move that much. So that's the volatility index, that's the fear index, and that's not very concerning as we speak. What did the FIs do in yesterday's trading session? What they've been doing in the past. They went ahead, they added 8,000 short contracts. So the swing factor out there is close to around 10,000 contracts because they unwound some longs, they added shorts. The short positioning is at around 83%. And from the start of the series, when we started off the series, I recall saying this market is missing out on those shorts in the system. Now those FIs, from being net short by only around 35,000 contracts, it's 135,000 contracts. So in the series so far, the FI short positions have gone up by close to under lakh contracts. And the clients, well, they were marginally net long. Now, in fact, they've added their long positions. It's gone to around 86,000 contracts on the long side. This combination is something that the street normally likes. FI's net short, clients net long. Now, since we are starting off the new weekly expiry, well, we have two strikes that were fairly active. So the 25,200 call, fair bit of open interest built up out there. There is writing being seen at this particular level. However, in case the markets get that positive trigger, there is some kind of buying that we're seeing at around the 25,500 call. It could be maybe a trade deal with the United States, maybe a couple of earnings that surprise positively as well. So there appears there is buying out here, there is writing on this particular strike. While on the put side, there is writing that we're seeing at around the 25,100 put out mark. And the 25,000 level becomes extremely important. It's the recent low. It's where the options data suggesting there is support. And also, the 50 DMA comes in that vicinity. So the crucial support is in this vicinity. 20 DMA, that's the line in the sand. You want to somehow get past that mark. So 25,325 will be the near-term resistance level. In yesterday's trading session, we had the Nifty Bank actually that broke the 20 DMA. Now it's pat in the middle of the 50 as well as the 20 DMA. You'll want it somehow to go back above the 20 DMA. That's going to be important. Axis Bank is going to be the stock in focus. Yes, the numbers are disappointing, even X of those technical write-offs. However, in the last 1 month or so, it seems the street was sniffing this because it's done a stark underperformance. If you compare what the Nifty Bank has done, you compare what Axis Bank has done, and sometimes on days like these, you mark the first hour low and you see whether or not there is a recovery. So I'll keep an eye out on Axis Bank. Though the numbers are disappointing, the street is very well prepared for that. And one stock that you spoke about is Indian Hotels. Management sounded very, very confident in their call. The stock actually has seen a fair bit of a correction from the recent peak. Valuation basis, well, there's a lot of support out there. And if you saw, there is delivery-based buying as well that we saw in yesterday's trading session and for the last few sessions. So Taj GVK is the one that I'm going to be keeping on the radar because of delivery-based buying. Stock has seen a correction, and valuation-wise, there is support on this one.
All right, Nigel, thanks very much for that. Prashant Paroda is now with us. He's portfolio manager, emerging markets at Allspring Global Investments. Prashant, good morning. Great to have you with us here. Thank you very much for joining us. That lack of trigger that we've been sort of referring to, could an India-US trade deal be that trigger? He's President Trump, of course. I mean, you can always say that when all this started, he kept talking about India, and the deal never came. But he's now once again saying that, well, maybe there are a few countries. India is very close.
Yes, I think we are getting very close. And he hinted to whether the deal would be similar to the Indonesia terms. So hopefully we can get across the line this time. And, we can put this behind us from a clarity perspective, from a company's perspective. It makes sense to kind of move along now.
And will that spur markets, Prashant?
I think some of it depends on what the number actually comes out at, right? If it's closer to what the Indonesia terms are, I think that's pretty much priced in with some of the markets. Again, a lot has changed in Trump 1.0 versus Trump 2.0 right now, right? If you look back in Trump 1.0, there was a lot of transshipment that went along, and a lot of that has been curbed in this Trump 2.0 trade deals. So with regards to that, I think India is pretty positively placed, and companies need to understand that, transshipment is not your competitive edge. Your competitive edge is your unit cost, and it will all come down to that once this tariff picture gets out of the way.
Prashant, hi, morning. On the US and just the overall sentiment, the fact is that evidence on ground, whether it's corporate earnings, whether it's retail sales, even inflation for that matter, everything has been solid and in the market's favor, which explains what the market's been doing, right? Do you expect this to continue in the next few months and quarters as well?
So I think the CPI data just came out, right, for June, and there was an increase in the year-on-year CPI. So a lot of the tariffs are not really affecting price right now because a lot of companies had built 3 or 4 months of inventory. And I think as you go down third quarter and fourth quarter, it will become clearer, especially from a Fed's perspective, whether inflation is under check or rising a bit. But we do expect some of these price hikes to impact those CPI numbers over the next 3 to 4 months.
Hi, Prashant. Good morning. Good to see you. Last time we chatted, India and I think Korea were the two indices you liked from two markets you liked from the emerging market pack. Do you stick to that? And also within the Indian markets, what are you doing? What are the sectors, the themes that you still like out here?
Yeah, so I think with India, we have to be very selective. I mentioned the banks right now. You know, some banks are kind of reporting subdued numbers. Other banks might do a little bit better. So I think within banks, we have to be very selective with, which companies are actually continuing to grow market share and have provisions under check. Within cement, I like cement as well. I think the price war that was happening over the last, 18 months, it seems to have abated and there's more price discipline. So some of those sectors are doing well as well. And telecom, of course, it's a 2.5 player market. So within that, we think the larger players will continue to do well.
Financials, cement, and telecom.
Yes.
Okay, got that. And as you're getting money, you're allocating to these sectors more, or
yes,
that question?
Yes, selectively we are, and I think Prashant, I think it will also come down to we'll be closely watching the commentary that these companies give as well. I mean, you might have a bad quarter last quarter, but the commentary going forward will be very essential for us to make bets from a 12 to 18-month perspective.
Prashant, I don't know, since you like financials, do you like Axis Bank? If you can, and if you can't talk about an individual name, that in general, I mean, the market will deal with this debate today that it's, they say it's extreme prudence, and now they're the most prudent bank on the street with this change in the way that they recognize bad loans. But it's led to a huge drop in asset quality. So just general thoughts?
Yeah, I mean, obviously, the drop is probably a surprise for many people on the street. But I think longer term, if this is a one-off issue, I think, people will overlook it besides maybe some negative sentiment going into this quarter. But I think the question is on a Q-on-Q basis going forward, if we see this as a one-off issue, then I think people will overlook it.
So in financials, I mean, I don't know. So do you own Axis Bank? What about other banks, mid-size? What do you like in financials?
We continue to have a position in large private sector banks. And I think they have, last few years, they haven't, except barring a few, they haven't really worked as well. So this is sort of some catch-up here for a lot of them, where consensus estimates are relatively benign, and we think they're going to meet or sort of beat those estimates. So we continue to rely on large private sector banks in this space.
And the RBI is trying to rev up growth, Prashant. This is a question which is, of course, playing out in both in India and the US. In the US, of course, in a more prominent way, President Trump attacking renewables, right? There is, I think, some news report which suggests that they're considering some anti-dumping for specific countries, and we'll put that in context. But is that a space you like? I mean, there are a few listed options in India, or are valuations a problem? Is all this news flow also a headwind?
Well, renewables, I guess, to the extent you're catering to the Indian market, I think there's a strong demand for that. To the extent that you're exporting to the US markets, I think it will kind of depend on kind of policy constraints on the US side. So I think if your market is sort of export focused, you might face a little bit of headwinds from the US side.
Prashant, Vari and Premier is like an optionality. There's enough demand locally so far, but that perhaps is an opportunity in the future. Thank you very much for joining us. It's always a pleasure.
Thank you.
We'll speak again. Thanks once again. We'll take a quick commercial break, but before that, let's just quickly run you through the interactions which are lined up here on the program. At 8:35, you'll hear from the Wipro management. We talk about the first quarter numbers. 9 o'clock, you'll have Ajit Kumar, JM Financial Institutional Securities, earnings, bank earnings and focus, Axis in particular. 9:20, Priti Gupta of Kotak Equities talks to us about sectors, themes he likes. Real estate is a big focus at 9:30, so we'll have someone from Cushman and Wakefield and Equirus Capital to talk about trends in the real estate space. And of course, REITs perhaps is also something we put the spotlight on. Tata Communications on their first quarter numbers, that's coming up at 9:40. 9:50, we'll have Elara Securities joining us to talk about expectations from the FMCG space. That's quarter se quarter thak today. And Lata gets chatting with the Indian Hotels Management, Puneet Chatwal, for their fourth quarter numbers.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you. We get to that in just a bit. For the time being, I give you a sneak peek into the list, our special top 10 segment. Wipro, Indian Hotels, LTIMindtree, Shopper Stop, Nuvoco Vistas, all of them will be reacting to positive news flow. Add to the list, Sterling and Wilson Renewables. On the flip side, Axis Bank, Tata Communications, CEAT, and Veranda Learning will be reacting to negative news flow. Take that break, come back. We'll get into further detail on all of these names.
Welcome back. So cues across Asia are actually pretty okay. Some of the regional markets like Hong Kong, etc., are running away 1% higher, but not, typically that's not really necessarily meant a 1:1 correlation for us here in India. We have been dragging our feet last couple of days. Anyhow, let's bring up the implied open and see what it is indicating. So far, the market's down about 0.5% for the week, 16 points higher. That is how the start could at least be. Let's get to stocks because there's a lot of very interesting stock-specific action that we need to go over. And we have our colleague standing by with a list of top stocks to watch. Rima, let's start with Wipro. Now, is it a glass half full or half empty?
I'd go with a glass half full, and even the ADR is pointing to a positive start, a gain of close to about 3.4%. Now, Q1 was muted, but it was muted on expected lines. Where does the positivity lie? The Q2 guidance says -1 to +1%, which means at the midpoint, we have no growth, 0%. But this is a 200 basis points improvement to the Q1 performance of -2%. So basically, Q2 is signaling an improvement, and the management said H2 is going to be stronger than H1. So that's reason number one. And two, this is underpinned by very strong deal wins that the companies enjoy. The total deal wins have come in close to $5 billion, up 24% quarter on quarter and up 50% on a year-on-year basis. So which is why I'm going to go with green for Wipro, because the Q2 guidance suggests an improvement, H2 likely to be better than H1, and deal wins are very strong this time.
Okay, all right, Rima, thanks for that. In fact, we'll get the management at around 8:35 a.m. later today, and we'll hear out what they have to say. So Wipro is a hint of positivity out there, but Axis Bank, those numbers were disappointing. As we mentioned earlier, the street was bracing for them. Gaurav joins us to explain that to us. Gaurav, numbers disappointing, but there's a technical factor at play. Please explain it to us.
Well, yes, as you said, disappointment seen from Axis Bank in first quarter. First was that the net interest margins have declined almost by 17 basis points. So the street was factoring in a fall of around 10 to 12 basis points. Bank has said that the 13 basis point fall was from repricing and 4 basis point because of the interest reversal. But what was something which was not anticipated by the street was the credit cost. Now it has gone up almost to 1.4%. Slippages have also gone up to 3.1%, and this is because of the technical impact that the bank has suggested. They have said that the technical impact has costed the bank at around 620 crore rupees on PAT level and 800 crore rupees on the provisional level. Now, that is the reason why we are seeing these elevated slippage cost and credit cost. Banks said that these will come down because there will be some recoveries from the quarters going ahead, and that is the reason why they are optimistic. But what they have done is that they have actually changed their provisioning policies, and that is the reason this technical impact was seen. Now, what is actually impacting and what is actually factoring in by the street is that this is actually at the cost of your book, because ROAs have gone down almost by 10 to 12 basis point. ROEs have gone down almost by 1.4% because of this technical impact, and that is something which will weigh on the stock. As a result, when we talk about brokerages, they have also cut down their stock target price. In the likes of Investec, they have cut down their target price. So definitely a negative impact is what we may see on the stock price, and a bad set of numbers for Q1 from Axis Bank.
All right, this is the big one, right, as we've been discussing, and we'll see how the trade starts and how this goes through the course of the day. Gaurav, thanks very much for that. LTIMindtree and Tata Communications, two other names. Rima, back to you.
Well, LTIMindtree, a decent quarter in line with expectations. The company's revenue has grown by 0.8% on a quarter-on-quarter basis. EBIT margins continue to expand as the company is implementing a Fit for Future program whereby they're looking to improve their margins at 14.3%. And the company spoke about being reasonably confident about growth momentum continuing into Q2 and also about margin improvement, while they too have not taken a decision on wage hikes yet. Now, for Tata Communications, on the other hand, it was sort of a subdued sort of a quarter. No fireworks. Revenues are down 0.5% on a quarter-on-quarter basis. On a year-on-year basis, revenue growth is just up 5.8%. EBITDA margins have expanded to 19.1% sequentially, but it's still lower than the FY25 average level of 19.8%. And profit, you will see a very sharp 80% decline quarter-on-quarter, but that's because last quarter had a big exceptional gain. Net debt for the company has also gone up.
In fact, all right, Rima, thanks a lot for that. In fact, we'll have the management of Tata Communications joining in at 9:40 a.m. to detail their Q1 earnings. Well, let's get to more interesting stuff then. It's a Friday morning, and in fact, Mangalam joins us to tell us about Indian hotels as well as Shopper Stop. Hey, Mangalam, morning.
Morning. So I'll be the harbinger of good news this result season, hopefully so far. So Indian hotels, good numbers coming in, and this despite the resilience or rather the headwinds that we saw. So resilient performance despite the headwinds. The hotel segment grew 14%. The new businesses of the company grew 27%. On a consolidated basis, the numbers look a lot better. That's largely because of, the amalgamation of the air catering business, TajSATS, that is. So reported numbers, 31% revenue growth, 28% EBITDA growth. Net profit grew by 36%. And this despite the company saying that 2 to 2.5% of the growth was impacted by Operation Sindoor and flight disruptions, etc. And 11 crore increase was on account of preponement of their increments for this year. So all of that, if you add back, it looks like a lot better set. The outlook for the second quarter looks good, and as does the entire year where they maintain their double-digit growth outlook. The hospitality sector doing extremely well. Similar is the case for Shopper Stop as well. On a reported basis, yes, the numbers grew by about 8.5% on the top line, but good operational performance, 14.8% margins. The company reported a net loss, but that's largely reported numbers because the depreciation element, which is a non-cash expense, is a lot higher for Shopper Stop. What's good for them is that they found their new engines of growth. One of them is beauty distribution, which grew over 100%. And the second one is their value fashion business, which is Intune, which also grew 100% year on year.
Okay, all right. So good news coming in for Indian hotels and Shopper Stop shareholders, I guess. And of course, you'll hear more from Mr. Chatwal, 10:15 a.m. He'll talk about the business and how the rest of the year looks like. Let's move on then. Thanks, Mangalam, for that. Let's move on and bring in Sud, who's looking at a bunch of other earnings that came in post-market hours yesterday. So, Darshan, morning.
Morning, Surabhi. So first, I'll start with CEAT. Results were largely below estimates, mainly because of increasing input costs that impacted both EBITDA margin and gross margin. EBITDA margin has slipped more than 100 basis points, and gross margin was down by 250 basis points. Revenue, though, came in largely in line with estimates, aided by OEM and replacement cost. Company has also announced expansion to the Chennai unit with an investment of around 450 crores. So I'm going with red for CEAT. Next stock is Nuvoco Vistas. Stocks earnings were largely higher than estimates. Cement volume has increased by 6%. EBITDA per ton has seen a sharp rise. It was up 43%. Even debt has fallen both sequentially as well as year on year. So I'm going with green for Nuvoco Vistas. Same for Sterling and Wilson. Here also company has reported a healthy set of earnings. Profit was aided by favorable operating leverage and lower cost, and that's the reason revenue was up 93%. Margin has increased to 4.9% against 2.7%. And one of the important orders that company is waiting to sign it, that is the Nigeria order, and company has commented that procedural steps are still underway and awaiting the final contract signing. So I'm going with green for Sterling and Wilson.
Okay, all right. Thanks a lot for that, Sid. Let's hop across to Vivek. He's here to tell us about Veranda Learning. Vivek, bang on. You said they're going to raise some money, and that's what they've said officially. Tell us more.
Well, that's right. So Veranda Learning Solutions is in focus, a large fundraise, especially when you're comparing the quantum of the fundraise to the actual market cap of the company. Along the lines of what we reported for yesterday, the company has launched a QIP for the fundraise. The total issue size is 380 crore, where the base size is 350 crore, with an upsize option of an additional 30 crore. The issue price is at a steep discount to yesterday's close. We understand the issue price is at 225.2 rupees per equity share, indicating an over 15% discount to yesterday's close. What is the usage of the proceeds? Like we had highlighted, the company intends to go ahead and prepay some of the long-term debt that they had. This is a higher finance cost long-term debt. So after the QIP, they will be able to go ahead and get significant savings as far as interest cost is concerned. This is of the subsidiary Vedanta Excel Learning Solutions Private Limited, and along with that, they also intend to use a certain proportion of the QIP proceeds for general corporate purposes.
All right. No, absolutely. It's a small name, but Vivek, congratulations. And there's a large fundraise for Veranda. Here's a quick recap of our top stocks with positive and negative news flow. So on the positive side, Wipro, Indian Hotels, LTIMindtree, Shoppers Stop, Nuvoco Vistas, and Sterling and Wilson Renewable. Stocks with negative news flow, Axis Bank, Tata Communications, CNBC, and Veranda. All right, so those are stocks, commodities. What's on the table? Manisha is here with that. Manisha, morning.
Morning, Prashant. Thank you for that. I'll start with the crude oil prices because it's a fourth straight day of drone attacks in Iraq's Kurdistan, and we do understand that this has now led to an output cut by 150,000 barrels per day. So immediate supply concerns. In any case, we are looking at tighter supplies, improved demand outlook, better economic data from US, and better than expected China GDP numbers. So all of these factors in turn have been supportive for the crude oil prices. The ongoing Israel strikes in Syria also have led to some support coming in for prices. And it's not just crude. If you look at the precious metal prices, there is some safe haven buying returning here. Gold is trading in the positive. Silver is back above $38 an ounce. Platinum has gained yet again to a new 14-year high at around $1,460 an ounce. We're also looking at some support continuing in case of many of these soft commodities. So whether it's sugar, rubber, cocoa, coffee, well, almost everything in the Asian markets right now seems to be trading in the positive.
All right, Manisha, thank you very much for that. So that's the commodities picture, rubber on Manisha's mind. We'll take a quick commercial break here. We're going to come back with the management of Wipro and we discuss first quarter numbers with them. Stay tuned.
Welcome back. So like we've been telling you, most markets across Asia are actually doing pretty well. But the indication that we have from the implied open is that we'll have a slightly more muted start. Look at that. Many of those markets are doing very well, including Australia as well. Singapore, all are higher. But for us, once again, just about 9 odd points. It's a little more quieter. Let's keep it with corporate earnings then, because the market is going to be very, very stock specific today. And let's look at Wipro. The company reported what was a slightly muted set of numbers for the first quarter. The top line did contract. Constant currency revenue was down 2%. The margin saw a little bit of a nick as well. But that was in line with expectations. However, the company is sounding very optimistic on the second half of the year and on their deal pipeline. In fact, Rima caught up with the Wipro CEO Srini Pallia and CFO Aparna Iyer, as well as the CHRO of the company, Saurav Govil, and began by asking them about the second quarter guidance.
If you look at our quarter one performance, specifically around bookings, $5 billion, two large deal wins that we had, $2.75 billion, out of which two are mega deals and one is likely to be a mega deal. So there is this very strong deal momentum that we have had in quarter one, which we trying to carry to quarter two. Of course, some of these deals will take its own time before we start ramping up.
But my question is, will this improvement continue? For instance, can Q3 be better than Q2, Q4 be better than Q3, X of seasonality? Because your Phoenix deal also ramps up in the second half of the year. So how is H2 going to be, to your mind? And can FY26 then be better than FY25?
So as far as we are concerned, we don't give a guidance for the full year. But having said that, specific to your question, second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
Okay. And FY26 vis-a-vis FY25, Srini?
I think net overall, I think it should be better than FY25.
Okay, got that. Aparna, are you confident of holding on to 17% margins at least at the baseline, given that, there is still, pressure at the top line?
We're very, very excited about the bookings that we've had in the first quarter of the financial year. Along with Phoenix, a lot of these deals will begin to ramp up. But for those deals to really translate into revenues, it will require upfront investments. There will be pressure on costs. That large deals typically come at lower margins. And there will be some pressures that we will have to offset. You've tracked our operating margin performance over the last 8 quarters. We've consistently improved. We will go back to that muscle of operational excellence that we will continue to drive. And those are the puts and takes on margins. We don't guide for margins, Rima, but we are happy with our performance in Q1, an 80 basis points improvement. And from there, we will take it.
But you have in the past spoken about keeping margins within a very narrow band. And that narrow band for you has been 17.5%. So are you confident with that holding for the next 3 quarters, given the puts and takes?
I'm not giving a guidance here. I've spoken about that there are going to be certain pressures in ramping up some of these large deals, and growth will be our number one priority. And we will continue to work on the levers that we have to offset some of those pressures.
Okay, so we can't rule out a margin decline from here on.
We're happy with what we've performed for Q1. We don't guide. And Rima have shared the puts and takes. And we will have to really execute on quarter 2 well. And from there, we will take it, like I said.
Aparna, Europe has deteriorated for you even further. Other than macros, have you been losing market share? I mean, what's happening, when it comes to Europe?
I think in Europe, we've had, for the last 4 quarters, we've not performed as well as we ought to have. It has been a combination of the macroeconomic environment, lower discretionary spends, but also certain client-specific issues that have played out. We believe we are very, very close to bottoming out. We have a large deal win that we have secured, and also some very good deals that we have also secured in Q1. Our pipeline is good, strong. So we are very, very hopeful of Europe bottoming out and coming back into performance starting second half.
That's helpful. Saurabh, when are you giving a wage hike?
Surima, we had given a wage hike last year in September. We haven't decided what's the plan now. We'll review it closer to the date, based on the macro environment, demand situation, what's happening, and we'll take a call. So nothing, as soon as we decide, we'll let everybody know where we stand.
Saurabh, in the last 4 quarters, last 12 months that is, your headcount is down by 1,200. I mean, what does that signal, and what are you planning with respect to hiring? Is it because AI is doing a lot of the coding that you don't need to hire that many?
So, the direct correlation, and Srini alluded to it earlier in the press conference also, for AI and hiring, I think it's still time for us. Evolving is the right word. But for us, the environment has been there. The demand situation has been tough for us. We haven't, seen this quarter. We degrew the previous quarter. So if you look at that environment, I think we have been really flattish on our headcount, and The hiring continues. We have gone to campuses last year. We continue to went this quarter as well. We continue to hire in wherever there is demand. We are, as we have built up these large deals, we are gearing up to deploy people. Our actually year-on-year attrition has come down because we have put people ready so that we can quickly deploy these people as we move into the execution of these deals. So net, depending on the demand environment, depending on the macro situation, our hiring will be there. Only thing I can say is that the supply side is well geared up to manage any demand environment. So that should not be a challenge from us. Be it look at hiring, attrition, utilization. If I put all these three things together, I don't see a challenge.
But do you think there is a possibility that you don't give wage hikes as you did in September this time around, given the macros?
As an HR person, I would love to give everybody a wage hike, but as I said, the business demands, the macro environment, the demand situation, we all will want to do the right thing. We'll let you know, how it pans out,
All right, well, interesting conversation there. Let's go get a fundamental view. Sid Khemka, Head of Research, Wealth Management, Motilal Oswal joins us on the show. Hi, Sid. Hope you're feeling rocking this morning. It's a Friday. Markets have been a little bit range-bound, but stocks will do a thing of their own, as would be the case with Wipro. How are you feeling about Wipro's numbers? And, from the tech pack itself, what's the top pick?
Good morning, Nigel. Good day to be on Friday morning. So I think if you look at Wipro, kind of mixed bags on the deals front, they did deliver. Going forward, I think the conversion will be a key monitorable. So the start to FY26 has been weak. The numbers are there for us to see. The IT services revenue has fallen 2% Q on Q on CC terms. However, what is positive that the deal wins have surged 26%, including 2 mega deals. Near term, I think Q2 will remain sluggish. The guidance is a flat -1 to +1 in terms of revenue growth. In terms of key positives, as I said, strong deal wins. Europe's showing some sign of stability. Margins likely to stay in a range as services EBIT margins stood at 17.3%, down 20 basis points for the quarter. But the expansion is limited going forward due to upfronting of costs of large deal ramps, plus what we heard from the management. Some of these large deals comes at a lower margins. So despite a minor upward revision and some of these positives, we kind of remain neutral on the stock right now. We'll see once Q2 numbers are there, when we'll get to closer to that Q3 quarter where things should start looking up. But as of now, remain neutral on Wipro.
Okay, neutral on Wipro. Now let's get to the big story of the morning, and that is Axis Bank. Just to revisit this, Axis Bank disappointed in terms of asset quality in the first quarter. What has essentially happened is the manner in which the bank is recognizing its NPAs, it has decided to change that to make things more prudent. Axis, in fact, is saying that now it is the most prudent bank on the street. This was not a diktat from the RBI. It's just the way they're recognizing bad loans and how quickly they're recognizing. And that has led to what they're calling a technical impact. This has led to a surge in slippages. Slippages have crossed over 8,000 crores. But the bank also says that it is quite confident about growing faster than the industry. And it explains how it feels that this technical impact has played out in Q1 and should not impact the upcoming quarters. Take a look at what the management had to say.
NPA classification happens on days past due criteria. And then there is qualitative criteria which is agnostic of days past due. We have not changed any day past due parameters because they are driven by regulation. The qualitative parameters, as we have previously indicated, we benchmark to most prudent in market on an annual basis. That benchmarking exercise happens for us in the period of Feb and March, and the implementation of that happens from the next fiscal. The purpose of the benchmarking is to make sure that our balance sheet is resilient and can withstand any credit cycle that comes our way, therefore giving you a robust, credible outcome when growth comes back. So roughly, if you look at what what we do is quarter one and quarter three are cyclical. And the way I would request you to think about it is in quarter one and quarter three, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
When Rajiv retires in August, as per expectations of RBI, we need to have MD, CEO and 3 EDs. Our NRC is actively looking at who and when we appoint a third person as executive director of the bank. When we're ready to do that, we'll be very happy to do it. But you should expect announcement of ED appointment as Rajiv retires. So that's the answer to one of your questions. Second question, I thought I answered in detail in the response to the first question, which was, yes, credit growth is where it is, but our confidence about what we can do the rest of the year and in the medium term, given where our platform is high. We are expecting to grow faster than the industry. I mean, obviously that's an expectation, but we are quite driven towards ensuring that we can deliver that output.
Okay, so two separate events. One is this whole technical issue with the NPAs, and then Mr. Rajiv Anand, very, very well-known Indian banker, finally retiring. And the critical question is, where is he going next? Is he going to IndusInd Bank? But that for another time. Siddharth, let's focus on the whole NPA issue with Axis Bank. Are you convinced with what the management has said, that this was technical, they are being extra prudent, and it will not slip over into next quarters?
If you look at, I think, very difficult to say that the bank has been consistently reporting weak numbers, and irrespective of what the management is saying, I think if you look at the other core business data as well, that is also showing signs of weakness. Loan book growth was muted at about 8% growth. Deposit base shrank about 1% on a sequential basis, raising the CD ratio to 91%. So I think while the management might sound prudent, the overall picture doesn't look that good. Margin continues to remain under pressure, elevated credit costs, higher slippages, definitely because of the internal loan reclassification. We have not heard that from any other bank, given that RBI has been scrutinizing the entire street, right from the largest to the smallest banks. So it's a bit difficult to digest that such stricter norms only apply to Axis and not to others. So we do see near-term headwinds, and I think it's better to stay away from such numbers until we see some stability. Even the other issue of the management, I think a big name there retiring, and they would need to hire some good credible name to bring the streets confidence. So overall, our rating remains neutral on Axis Bank.
So neutral on Axis Bank. So that's the Motilal view. And the street is really divided on this one. Nuvama has, for instance, downgraded the stock. JM Financial is retaining their buy. So it's a split house on Axis Bank. And we'll see. The market will give its verdict soon enough, guys. So promises to be definitely perhaps the stock of the morning, purely from a news and earnings flow.
All right, let's talk about a couple of good earnings then. Sid, Nuvoco's numbers came out and they looked quite good, actually. I'll tell you what, the problem is they've gone ahead and they've done that Vadraj acquisition. So that's why the street will get a little bit skeptical on. They need to come up with money. Otherwise, the numbers look good. Realizations are up. Profitability is at around 1,000 rupees per ton. And they've been reducing debt as promised. It took a little bit of time, but now they've got their act together. The stock, though, has already run up 10% in the last 30 days or so. Your view on the stock?
Nigel, unfortunately, we don't have coverage on Nuvoco, but overall, I think cement companies have been reporting good numbers, and we are expecting a strong quarter from cement in this quarter.
Okay, all right. Siddharth, stay with us. More questions coming your way. We have to take a quick commercial break, though. There's 11 minutes to go for the pre-open session. And we are also going to be back with Srikanth and Mitesh with their technical trading ideas. Stay tuned. Okay, welcome back. 9 minutes to go for the pre-open session to kick off. 18 points higher as far as the GIFT Nifty is concerned. Shrikant, Mitesh, good morning. Great to have both of you here. Mitesh, how are things looking? A flat open once again, but yesterday the market slid a little bit.
Morning, Prashant. So I think the structure in the short term isn't very positive. Getting past 25,300, 320, which is where the falling gap was, I think, and still is, I think is an important level. Till that happens, I think you will see the market facing supply at higher levels. And on the downside, key supports are now coming around 24,900, 24,880 zone. In case we break below that, then we'll look for a decline. But otherwise, it's a market which is tapped between two levels of 24,900 broadly and 25,300.
Okay, all right. Got that. Shrikant, what about you? How are you feeling about the markets? The Nifty has been a relative underperformer in comparison to the global markets. We're still in a bit of a band. One would say that maybe it's a blessing that you have so many FI shots in the system, more than 1.3 lakh contracts. Your take?
Good morning, Nigel. Good morning, everyone. See, for Nifty, the important level was around 25,500 levels. But now, based on the statistics, the resistance have shifted from 25,500, 550 to 25,300, 250 levels. So till the market is not crossing 25,255, to be very precise, we are going to see range bound sort of activity in the market. And in case if there is any correction close to 24,900, then there we should look for taking some contra bets of going long. But at these levels, it is in between. And today, below 25,100, we are expecting further more weakness. So broadly, I am of the view that we need to be more stock specific. And in case if there is any correction, then there we should look for taking some contra bets of going long.
Got it. All right. Contra bets, contra call is what Shrikant has. Mitesh, coming across to you, individual stocks, what's the view?
Morning, Nigel. I have a mix of buy and sell, slightly more biased towards the long side. The first stock is Jindal Steel and Power, which I would recommend buying with a stop below 939 for targets of 975. Sona System is another one, which is a buy with a stop below 475 for targets of 510. After a long time, some signs of profit booking on Indigo. So that's a sell with a stop at 5840 for targets of around 5720. And Godrej Consumer is a conditional buy. It's just trading below that supply pivot of 1285. So, if it clears that, buy with a stop at 1269, look for a first target of 1320.
Okay, and Shrikant, what about you?
Yeah, I would like to go with PSU banks. There we are seeing a good amount of strength, especially State Bank of India has crossed its immediate resistance level and it is sustaining well above that. But if we consider other mid-sized banks, then there also we are seeing equal amount of strength. In that specifically, we like Punjab National Bank based on its technical formation. It is around 113, 114 levels, but we can again see the levels of 120, 122 in the near term. That's my view. And we can keep a stop loss at 110 for the same. The other stock which we like is Nuvama, which is around 7,820. There also I am expecting stock to surpass its previous high of 8,500 based on its technical formation. It is again rebounding after hitting the lows of 7,500. So at this level, it's a buy with a stop loss close to 7,700.
Okay. We'll take a quick commercial break here, but Mitesh and Shrikant, we're going to reconnect at 9:10 for some more trading ideas. We'll take a quick commercial break here. We'll come back with a pre-open session. We'll have Ajit Kumar of JM Financial Institutional Securities to discuss bank earnings and, of course, Axis in some detail.
Welcome back. Well, in a few minutes, we'll get the pre-opened rates. But for the time being, let's continue our fundamental analysis. Sid Khemka is in conversation with us. Sid, what about Indian hotels? the numbers were expected to be a little bit softish. But, Mr. Chatwal is sounding very, very optimistic about the way ahead. And the hotel industry itself is poised for better times. What is your view on the stock and what's the pick of the pack?
Definitely, Nigel. I think while this expectation was not that strong for the hotel sector for this quarter, I think Indian hotels and earlier ITC hotels both came out with strong numbers. The commentary also looks pretty strong. So overall, I think even for the quarter, the numbers were pretty strong for Indian hotels. Revenue grew 32%. We have seen healthy RevPAR growth of 11%, and the company is maintaining a double-digit revenue growth guidance for FY26, favorable demand-supply dynamics. So I think one biggest concern was that with the strong upcycle in the hospitality space, is supply catching up? And what we understand from the management is that supply is still lagging demand, and hence the upcycle in the hotel industry could continue. We continue to like Indian Hotels, which is our preferred pick in the hospitality space. It is our top pick. We have a buy rating and a target price of 900. Giving an upside potential of 19%. The second stock that we like in the space is LTIMindtree in the mid-tier space, consistently expanding into newer territories, mainly targeting your business, religious tourism, tier 2, tier 3 towns. With the development of many new airports now flying to many of these tier 2 towns in India, as well as religious places, have become pretty easy and is driving the tourism growth. So overall, very positive view on the hospitality space. Top pick there being Indian Hotels. We continue to like it for the strong growth, healthy traction in the core business, as well as some of its new business that they are driving.
Any view on Taj GVK? Have you looked at that company?
Unfortunately, not looked at that.
All right. Thanks very much for joining us. As always, said, good speaking with you. Axis Bank is the one that we want to focus on. Disappointed in the first quarter. Asset quality deteriorated, which dragged profits. Came as a surprise. Let's just put the numbers out first, and then we'll bring in the analyst. Gaurav, take it away.
Well, yes, Axis Bank actually reported weak set of numbers. It was actually expected to report weak set of numbers, but the numbers that they reported were weaker than what the expectations were. Now, first, let's talk about numbers. Net interest margins declined almost by 17 basis points. Now, the street was expecting this decline somewhere in the range of 10 to 12 basis points. Another disappointment was the asset quality. Now, Axis Bank has actually upgraded their provisioning norms, and that is the reason there is a technical impact in this quarter. But this technical impact costed almost 620 crore rupees on its profitability. So when it comes to provisioning, around 800 crores of impact is what we have seen because of this technical changes that the Axis Bank has done. And that is the reason why we talk about credit cost that has also gone up almost to 1.4%. Same trend was seen in slippages as well. Slippages came in at around 8,200 crore rupees. And if we exclude this technical impact, slippages would have been around 5,400 crore rupees. So a huge impact is what we saw in slippages as well. As a result, profitability came down almost by 4% on a year-on-year basis. Now, bank highlighted that there was a 600 crores of impact on profitability because of this technical impact. At the same time, if we quantify this impact, ROAs declined almost by 15 basis points and ROEs declined almost by 1.4%. So without these technical impacts, the ROAs would have been better almost by 15 basis points. Another point to highlight is that the loan book growth has been slowing down now. Management is saying that the loan book growth will pick up and it will be higher than the industry in the medium term. On the other hand, they are also saying that the slippages are likely to come down because there will be recoveries in the coming quarters. So they expect slippages to remain muted for the next 3 or 4 quarters, and the recoveries will actually help credit cost to come down. But what Street is also penciling in and what analysts are also saying is that the slowdown is going to be there in the loan book. They're expecting 10 to 12% growth in the loan. And at the same time, because of the valuation comfort, they are actually maintaining their buy. But we are seeing the price target price cut across the brokerages. We have seen Investec, IIFL cutting down their target price. So definitely a negative impact is what we're expecting on the share price as well. And weak set of number is what we have seen in Q1 from Axis Bank.
Okay, all right. Thanks a lot for joining in, Gaurav, and explaining that very, very crisply to us. Let's get a view then coming in. We have Ajit Kumar, lead BFSI research analyst at JM Financial, who joins us on the show. Hi, Ajit. Good morning. Thanks a lot for joining in this Friday morning. Axis Bank, things not looking too good, for shareholders out there. But, the stock as it is has underperformed in the last 1 month. It's as it is down close to 5%, while the Nifty Bank is up 2%. And now we're bracing for another 4-5% cut. Do you think the street will look through this technical write-off, or do you think there are other reasons to be concerned out here? Your view.
Good morning, everyone. Thanks for having me. So yes, Axis Bank has given a disappointing set of numbers in 1Q26. But just 2 to 3 things I wanted to highlight here. On the operational side, everything was broadly in line. So like, for example, loan growth of 12% YOY, NIM decline of 12-13 basis point adjusting for the interest income reversal. Both of these were in line with our estimates. In fact, operating profit, PPOP, was 4% above our estimate due to higher treasury gain. So operational side, things were in line with the estimates. Yes, on the asset quality side, there were additional slippages of around 2,500 crores due to the accounting change done by them. But here we have to remember that more than 80% of these additional slippages are secured in nature. And since it is secured in nature, we will see some bit of recovery coming out of these additional slippages in the later part of the year. So yes, these additional slippages are negative in nature, but at the same time, we need to remember that since more than 80% is secured in nature, recoveries are going to happen in the second half of the year. The other point I wanted to highlight here is if you look at the valuation of Axis Bank, right? Currently, it is trading at 1 standard deviation below historical mean, right? And if you compare Axis Bank with some of the other banks on all the operating matrices, despite the soft quarter, is actually much better. So while this is a disappointing quarter, but having said that, this is not the end of the road. We continue to like the name. We remain buy with unchanged target price of 1,000.
Yeah. So you would be looking to buy the dip today?
Yeah, correct.
Okay. Ajay, just curious. Hi, morning, Surabhi here. Just curious. Wonder why the bank moved to do this. I know their explanation is that they are just being extremely prudent. But had they indicated this to the analyst community in earlier calls, that they're going to change their NPA recognition practice?
Not much, Surabhi, but having said that, there are few other lenders who are actually tightening their, recognition criteria, whether it is bank, whether it is NBFC. We have seen, 2 or 3, lenders doing the similar stuff in last 1 or 2 quarters. So it's on a prudent line. While it is disappointing in the near term, but I believe, over a longer period of time, this is a prudent move.
It's a healthy. Okay, so fine. I take your point, and that's exactly the argument the bank is making, that it's just a cleaner, healthier book over the long term. And they've realized all the impact one shot in the first quarter. So let's move beyond the NPA conversation. But even then, margins, look at the margin fall, I think 17 bips thereabouts, a little more than what the street had in mind. Loan growth is about 8%. Again, not really lighting up the charts. What about those parameters, margins and growth?
Well, Subhi, the numbers are soft, but this is going to be the trend across the, financials in this quarter. When the sector loan growth itself is 9.5%, we can't expect, the large banks to outperform them, materially. And these numbers were broadly in line with the estimate. So loan growth of 12% YOY was exactly in line with, our numbers. Yes, there is a margin decline of 17 basis point, which is higher than, let's say, 12-13 basis point that the street was penciling in. But at the same time, we have to remember that within that 17 basis point Q&Q decline, there are impact of interest reversals. So if you exclude that, because there were additional slippages, right, in this quarter, and due to that, there were interest income reversal that happened. If you exclude that, the margin decline was roughly 12 to 13 basis point Q&Q, which was again in line with the estimate. So I'm not that much, disappointed with the operational numbers. But yes, on the asset quality side, there is some bit of disappointment as far as these additional slippages are concerned.
Ajit, let me ask you this for our viewers, right? Earnings are still coming in. Anything you'd like to position yourself for where, in terms of tactically speaking, where you think numbers could be, could surprise one way or the other out of your coverage universe?
Yeah. So, in such kind of scenario where loan growth is not there at the sectoral level itself, as I said, 9.5% credit growth, asset quality is not completely out of woods, and there are margin pressure which is coming through. In such kind of scenario, our preference is more towards the larger names, more safer bets, whether it is banks, whether it is NBFC, and that is why we stick to larger private sector bank or even SBI for that matter in the banking side. And in the NBFC side, our preference is more toward the larger name again, Bajaj Finance. So yeah, when the macro environment is not that great, our preference is more towards the safer bets rather than going into the, going down to the curve and let's say going into tier 2, tier 3 names.
Okay, I just want to have a follow-up question there. Ajit, give us a second. We should look at rates as well, the pre-open. So Axis is taking a knock of about 7.5% in pre-open. Let's get the rates up. We should look at Wipro as well. Remember the question I asked Rima was, with Wipro, is the glass half full or half empty? And Rima said it's a glass half full, Surabhi. And that's what the stock is indicating right now, because the deal wins and the commentary for the second half are very, very promising, though the first quarter has been slightly soft. So Wipro is looking good. And Axis is still down about 6.5%. Just to complete that point, Ajit, you said that you will not go down the curve too much, looking for tier 2, tier 3 lenders. Just expand on that, because a section of the market is doing exactly precisely this.
Yeah.
And, stocks like whether it's the Bank of Maharashtra, look at the institutional buying in RBL Bank, names like AU Small Finance Bank. So there almost seems to be a race to find a mid-cap or a small-cap financial stock that can give you super returns, because the big banks are not moving. Why do you think that this is not the right way to go? And is there anything that you like in tier 2 financials?
No, so we have few, preferences at tier 2, tier 2, tier 3 financials. The only common thread in our picks is we are preferring, players where there are not much asset quality concerns. Growth and margin is actually second or third variable that we are looking at. It's the first asset quality that trend that we are focusing on, and in that regard, City Union Bank in mid cap, we prefer. DCB Bank we prefer in the banking side. In NBFC side, our preference is to move toward the housing finance company like such as PNB Housing Finance, Aadhar Housing in, let's say, affordable housing players. And as I said, the common thread among all of them is the asset quality concerns are not there that much. As compared to some of the other riskier name. While market is chasing growth, and that is why getting into all those tier 2, tier 3 names. But my sense is in FY26, credit cost for all the lenders is going to be much higher than the expectation, and even more so for the tier 2, tier 3 names who are exposed highly toward this unsecured loan and, let's say, MFI loans. And that is why even in tier 2, tier 3, we remain highly, highly selective.
Oh, okay, that's a different view. Haven't heard that too frequently in the marketplace, that this could be a year where we need to watch for credit costs. Interesting one, Ajit. We'll remember that for sure. Just to wrap it up, a quick call on SBI. Mega fundraising exercise underway. What's your call?
So we like the name. So while 25,000 crore looks, high in terms of the absolute quantum, but looking at the balance sheet size, it's a minuscule for them, to be honest. I mean, there's not much impact on the CET ratio. Hardly 15-20 basis point positive impact is there on CET ratio. But capital raise or no capital raise, we do like this bank from longer term perspective. Yes, there is a margin pressure which is going to come for SBI as well. But all said and done, the entity is printing more than let's say 15-16% ROE. And anybody who is having, let's say, longer time horizon of 2 to 3 years, SBI is one of the more safer and preferred bet.
Okay, all right, got it. So stick to big banks. That's the advice coming in from JM Financials. Good conversation this morning, Ajit. Thanks very much for joining in. Well, with that, let's turn our focus back to the market. The index is flat. It's all about individual stocks, as the case has been. Look at the Nifty, just 3 points lower. Now let's look at stocks. So I pointed out, obviously, the sharp moves on Axis and Wipro. Axis still down 6, Wipro is up about 3. Look at Indian hotels. I mean, stellar performances being met by stellar reactions as well. And yesterday was Ixigo. Indian hotels also has been looking fairly solid this morning. It's cooled off a little bit. It was when it opened up in the pre-open, it was even higher. Nuvoco is the other one. Nuvoco in the pre-open is popping almost 7%. So let's watch for this. On the other hand, Shoppers Stop. Mangalam was telling us the operational performance is better, and it is better. But at the net level, there is still a loss. And that loss year on year is looking bigger. So that could be one reason why the market is a little disappointed in terms of Shoppers Stop. So that's how it's playing out, all about individual stocks that are catching the eye. I think we've got Mitesh with us. Mitesh, of course, we want your 9-10 call. And also just give us a view on Axis Bank specifically. If it opens down 6-7%, what would you do?
See, Axis Bank, the chart has been weak for the last 2 days. In fact, if you look at State Bank of India, it's made a new high, getting past 825, 830, while Axis Bank, after registering a high of 1250, was down to about 1150. And with this gap down, I think we might see the stock, get below levels of 1100 and head towards 1040, which is where the next supports come in. The structure is weak, so I would not even want to buy it then. Maybe you'll get a bounce back, but not keen to buy.
Okay. Yeah.
Yeah, your 9-10 call,
please.
yes.
For 9-10 call, I'll go with a buy on Jindal Steel Power. look for targets of around 975 to about 980.
Okay, JSPL on your radar. Cut that. Thanks a lot for that, Mitesh. Well, let's hop across to Vamakshi. She's here to tell us about 361 WAM. Vamakshi?
Well, Nigel, the AUM growth out here was quite good, up almost 14% quarter on quarter as far as the total AUM is concerned. And this was largely driven by the wealth management AUM, which saw an uptick of almost 15% sequentially. ARR flows were boosted by mainly completion of the BNK acquisition. Keep in mind that the revenue growth, on the other hand, was up only 2% quarter on quarter. It did not mirror the gains that we saw in the AUM, and that is because we saw the yields on ARR AUM declined by 4 basis points, and the yield on TBR AUM also declined by around 2 basis points. Total operating costs grew at a faster pace as compared to the growth that we saw in the revenues. Resultantly, the cost-to-income ratio spiked up by 171 basis points, and the operating profit declined by 2% on a sequential basis. The net profit, though, came in almost 15% higher quarter on quarter, and that is mainly on account of the growth that we saw in other income. Now, there was a conference call that was held yesterday, and the commentary that came through from the management sounded quite optimistic. They're targeting ARR net flows of 20 to 25,000 crores from wealth management and 8,000 to 10,000 crores from asset management. They believe that the flows could remain subdued in the near term on account of RM attrition, but however, they're expecting to recover over the rest of the year. ET Money's cash burn has also meaningfully reduced, and as integration synergies begin to materialize, scale bids up, they expect to see gradual improvement in cost efficiency as well. So that is how 361 WAM's numbers shaped up this time around.
Got it. Thanks a lot for that, Vamakshi. Well, Nuvoco Vistas, surprise, surprise, delivered a very, very good set of numbers. Volume growth was average at around 6%, more or less in line with what the industry did. The revenue was up by close to 9%, telling you there was some realization gain. On a sequential basis, in fact, the realizations were up by close to 5% quarter on quarter, and that led the way because the operating profit came in at around 520 crores, which is one of the best we've seen on a quarterly run rate. Margins were at around 18%, but the EBITDA per ton, I've calculated that came in at around 1,000 rupees, which is a sharp improvement on a sequential basis as well as on a year-on-year basis. The net debt number, that's the cherry on the cake, that as well has come down. So put everything together, realizations up, cost under control. They are guiding that cost will come down by another 50 rupees per ton. Valuations in favor and net debt comes down. Good set of numbers. The stock is still a far cry away from its IPO price, but for the time being, the street will like what they saw.
All right, I think we've got market open coming up in just a couple of seconds now. I mean, once again, as flat as they come. Maybe not as flat, but yeah. You got the Nifty, which is flat. Yeah, nothing unchanged. 25,118. The Nifty Bank is down about a third of a percent, 56,640. So that's a more decisive. And I think Axis has got something to do with it. It'll come up on your screens. But 0.4% lower on Nifty Bank straight off the bat. Axis is down 5%, as you can see, and I think outsized sort of pressure on the Bank Nifty. Mid-cap index is flat. The small-cap index, perhaps, I think, coming up should come up flat as well. And the Nifty heat map will give you a quick sense of how we are starting, but it's all about stocks, so we want to get to stocks very, very quickly. What do we have on your screens? 25-odd names are higher, and about, not 25, 35 names are higher. About 15 stocks are in the on the downside, but Axis really is putting pressure. Surbhi.
It's a classic bull versus bear on Axis. I mean, the bulls will say that in longer term, it's actually good. It's a sign of strong prudential management. But the bears will say, hey, Q1 was bad and we weren't prepped for it. 4.5% down on the stock as we speak, but it's cutting its losses from a 6% gap down. So let's see how this plays out. What else is weak? Bharti, Airtel, Kotak Mahindra Bank, SBI, SBI Life, Bajaj Finance. In general, financials are weak. And the knock on Axis has taken the Bank Nifty down 0.5% as well. ICICI Bank is also a little weak. And the others are not able to offer much of a counterweight. I mean, HDFC Bank is just 6 rupees higher. SBI is also on the lower side. So banks are weak, short point. Let's look at Wipro. Wipro is a bright spark on the Nifty this morning, 3.5% up. Remember, the first quarter was soft, but deal wins are looking very good. Commentary for the second half is strong, and the market likes that. So 3.5% up. Jio Financial reported numbers. Growth is picking up. 1.25% higher on Jio Financial as well. Other gainers on the Nifty. Once again, the metal stocks are continuing their shining ways from yesterday. So Tata Steel, JSW Steel, maybe global risk on mode. Global markets have been holding up as well. That seems to be working for this part of the market. Even Hindalco is up 0.5% higher. So metals are shining bright. Aside of that, then it just completely flattens out. Some buying on Infosys, some buying on L&T. Let's look at Reliance finally before we move to mid-caps. Reliance ahead of numbers, very quiet, just about 2 rupees on the higher side. Nifty down 17 at this point. Nigel?
Well, a few stocks that are catching your eye from the broader markets. Nuvoco, the numbers were good. I'll be interested to see whether or not it can sustain this 8% gain because, the IPO came at more than 500 rupees, but they're doing the right things. If it wasn't for Varadaj asset that they've taken into their books, because now we'll have to wait to see how they turn that around in the next 2 years or so. But no worries with the numbers. Realizations up, cost under control, debts reduced, and they have valuation comfort as well. So let's see whether or not it can build onto those gains. For the time being, an 8% pop, I think, factors in the good set of numbers that we have seen. The other one I'm looking at is Afcon's Infra. Well, that's up close on 4.5%. They won a large order. So that's why the street likes that one, 4.5%. Good going out there. Wipro continues its winning ways, and SmartWorks co-working listed yesterday, good gains out there, building onto the gains today as well. So SmartWorks, in fact, up close to around 2% as we speak. Lert Avenues Tech, that stock, in fact, was much higher in yesterday's trading session. It ended at the circuit. Today, there is some cooling off. There is an Anand Rathi note that I'm looking at. They find valuations a bit stretched at around 68 times forward earnings. Hence, they initiate coverage with a hold rating on the stock. 230 rupees is the target price. Some cooling off after the big run that we've seen on that one. And Navkar Corp as well, I think that came out of a set of numbers. Large volumes today. It's down close to around 1% or thereabouts. So, though we have the headline index, it's more or less flattish. Stocks in the broader markets doing a thing of their own, bouncing around.
Well, 0.07% change on the Nifty at this point. So large cap, the Nifty index not doing very much at all at this point in time. Let's welcome in Prateek Gupta, who's with us, CEO and co-head at Kotak Institutional Equities. Prateek, great to have you with us here on the program as always. Thanks for your time. Do you think one of the reasons, sort of almost primary reasons, of course, earnings have been tepid, etc. We all know that, but there's so much supply, right, which is constantly hitting the market. Just take SBI's 25,000 crore round, and so many others who are kind of sort of coming to the market and quietly raising money, successfully raising money. There's a fair bit of supply, so money is getting sucked out of the system. What is your sense? I mean, on balance, because very, very evenly, almost sort of, these levels, at least at an index level, things are pinned to the board, not moving very much, very tight band.
Yeah, good morning, Prashant. I was actually just discussing with someone earlier this morning that our market seems to be, if you remember the old Ajit Mona Darling jokes, like in a liquid oxygen state. Pretty much range bound. You've got, on one hand, you've got the very weak earnings outlook, as you mentioned, valuations which are expensive. Nifty is trading at almost 22 times 1 year forward. And you've got a huge paper supply pipeline. We had SPI yesterday, many other large IPOs and a lot of blocks and QIPs in the pipeline. So that's going to sort of cap the upside. And on the downside, there's a lot of support from continuing local flows because your alternatives in fixed income property are no longer that attractive. You have the prospects of a much stronger second half. So there's hope that earnings will recover in the second half. And then you've got the US dollar weakness, which will hopefully trigger EM inflows as we go along in the next 3 to 6 months. So sort of stuck in a range-bound mode for the short term and pinned to the wall, as you said. So it's pretty frustrating for a lot of investors who are either waiting for a market correction to buy or waiting for a market rally to sell. So pretty subdued activity at the time for the time being.
That line, Prateek, I was hoping that when you started with the Mona Darling line, I thought you'd say it. मोना डार्लिंग इसको लिक्विड ऑक्सीजन में डाल दो लिक्विड इसको मरने नहीं देगा ऑक्सीजन इसको जीने नहीं देगा that's the line.
Gentlemen, out of the park this morning. I went to Google immediately. Ajit Mona Darling.
I mean, how can you, Nigel? I mean, you're not that young. This is.
Now it feels like a Friday. Actually, thanks for that, Prateek.
But we have heard about this.
Old movies playing in the house at some point in time.
Come on.
This is not 90s. We're like 90s kids and all.
This is iconic.
No, but okay, to bring this back to the market, Prateek, please elaborate. Now, who is the Mona Darling? Which sector? What is the liquid oxygen? Is it the liquid flows? Please elaborate on this very, very interesting analogy that you picked up this Friday morning. Because if you're talking about flows, then that liquid oxygen is not even there. Where are the FPI flows? Half the year is gone. We thought there'll be plenty of liquid oxygen, but it's not coming.
No, in the joke, the liquid is the thing that prevents, will kill the guy, and the oxygen is what will give him these support to fill.
Okay.
So the liquid in this case, what will kill the guy is really the valuations which we are at 22 times. Very few stocks are at attractive valuations. Earnings growth, as Prashant was saying, is pretty pathetic. If you look at the large sectors, you look at IT services, consumer, banks, you'll get, at best single-digit earnings growth this year. So that's sort of what's capping the upside. And in terms of the downside support, you've got local flows because, like I said, money is not going anywhere else. It's coming into equities, risk capital, that is. And you have prospects from, for example, you could see the impact of the rate cuts by the RBI and potentially even more rate cuts given the very low inflation print we saw in June. You could see, finally these things feeding through into the economy and the long sort of, and you could see government capex coming through in the second half. Post monsoons, we could see a rural recovery. All of these factors should come together in the second half. So therefore, it's sort of pretty range bound at the index level. Obviously, individual stocks are doing their own things, but at the broader market level, tough to see this market moving out of the sort of range.
Now it makes full sense, Prashant. So liquid ise jeene nahi dega is the valuation and the earnings, but oxygen marne nahi dega. That's the retail money flow. Now we understand.
I remember the dialogue, but you got to go with Ajit's delivery. I mean,
you nailed it.
I can do it, but I don't want to do it.
Over it, Prashant.
And you should try it.
Yeah.
On popular demand.
Lights, camera, action. Prashant.
I'm not going to do it. Go on. By the way, just to take that point forward, Ramdevji was on, right? And I don't know if you watched that conversation, Prateek. This liquid oxygen, basically he put it another way. This is, of course, but Ramdevji said cap and floor. The cap, according to him, is all the supply which is coming in, and the floor is all the supply, all the sort of money which is coming in.
The retail money, yeah.
So, and that's the liquid oxygen, which I think that's another way to describe liquid oxygen.
All right, interesting Friday morning, Prateek. We started off, we had our top 10, and Surbhi was asking Rima, the glass is full or half full. It's a Friday morning, so I was just wondering what's going on. And now we have a slew of jokes as the markets open. Let's get back to earnings. We spoke to Mahesh of Jefferies last week, and he said quarter one is going to be weak, but he's breaking for a very strong bounce back in quarter two earnings. And the rationale he gave us, that it's going to be on a softer base. Some part of this liquidity that's released into the market will start picking up. And since we are hit by early monsoons, maybe the monsoons recede as well earlier. And besides that, the most important is Diwali is relatively earlier. So spends will pick up in September. Are you in that camp that believes that we'll see a good earnings recovery in quarter two? And for the year, you're still sticking to that 12% earnings growth?
So yes, Nigel, we also believe that the earnings growth outlook will be much better in the second half. For the June quarter, our projection is at Kotak that the Nifty earnings, for example, will be growing only by about 4.5% YOY. Whereas for the full year, we are projecting about 11% for FY26. So clearly that means in the next 3 quarters, we should see a much stronger earnings growth. Having said that, a lot of it is priced in already, both the negative news as well as the second half recovery, negative news of the first quarter and the second half recovery. Just look at the valuations of where all the stocks are trading at. You, like I said, you look at the consumer stocks, the IT stocks, the bank stocks. They're already sort of, I don't think there's going to be a major surprise, barring a few odd stocks here and there, that broadly almost every investor is expecting a very weak set of earnings from the first quarter and a pickup in the second quarter. I think the main market moving events will be something other than what's already going on, all this second half recovery. It could be things like you get a favorable trade deal with the US, for example, or perhaps on the downside, an unfavorable trade deal. So that could be one. Second, you could see some government action in the form of, say, perhaps petrol and diesel price cuts at the retail level. That could pump some money back into the economy. GST, we think there'll be just some minor tweaks, but perhaps there could be something more over there. But I think the real big trigger will have to be things like government capex coming in a big way in the second half. And that's always a bit tricky to project how much of it will be driven by the center, by the states, the PSUs. So that's really where we are. So we are sort of expecting a much better second half, but it's sort of priced in. So to break out, you need something else happening, which at least at this point in time, there's nothing going on.
Okay, so all right, Prateek, let's sum it up then with what should be done. I mean, you described the situation really well, and I think this is the reason why we're not getting that deluge of foreign flows. We started the year expecting that US exceptionalism will end, and it has, but it's Korea and China where the money seems to be going. So in this context, what should investors be doing? Where do you see some prospects of growth and some valuation sanity? Leave us with the top ideas. I think defense is something you've always liked. What else?
So firstly, on the foreign investor side, I'd just like to highlight that most global investors are still neutral to largely underweight India, just given the expensive valuations. India has underperformed the MSCI EM index. You mentioned Korea. Korea is up 32% this year in local currency terms. Other markets like Hong Kong or Brazil and Mexico, they're up 15, 20%. So India is clearly underperforming. But even then, people are staying away. And you've seen the flows into the FPI flows into India last few weeks. We haven't seen that much coming in. Now, as far as the sector preferences are concerned, in this sort of a market environment, either you go with companies where you have strong earnings growth visibility or where valuations are in your favor. And that's a tough one to find. So we still like the banks and the NBFCs and the insurance companies where earnings growth is not that great, but at least valuations are somewhat reasonable. We still like the hospital space, the entire healthcare space, where, again, in this case, valuations are not supportive, but you have very strong earnings growth outlook for the next couple of years. Hotels is another area. Telecom is another area. So these are sort of the sectors we like. One general theme we would recommend investors, at least for the time being, to stay away from is export-oriented plays. These are like IT plays, the global auto ancillary plays, or the metals. We believe a global slowdown is in the works. The impact of the tariffs, etc. Already we're seeing this in China slowing down. US, we think, will slow down in the second half. So when two large engines of the global economy slow down, tough to see the overall global economy not slowing down. So overall, we would stay cautious on the global export plays, focus more on the domestic plays.
Okay. All right. Prateek, thank you very much. A great conversation as always. Insightful and, might I say, very entertaining. Brightened up our Friday morning. You have a great day and we look forward to connecting.
I hope you'll
by the end of this day, you'll have to enact. If not on air, off air, for sure.
You'll give the idea to Sanjeev, Prateek. The research note titled Liquid Oxygen. I think it'll be a super hit.
Prateek, I'm sending you an invite for drinks later this evening, and we'll do all the enacting over there. All three of us and you.
Okay.
All right. Thank you very much, Prateek. Appreciate you joining us as always, and good chat. And look forward to the next one. Guys, the market is doing. Let's just put the Nifty up for a quick bit, and then we'll just move on to our next discussion, which is, of course, another asset class, equities, real estate. Real estate is, of course, has been doing pretty well. 30 points lower on the Nifty. The real estate index is up about 1/3%. But so it'll be commercial, residential. What are we talking about?
Real estate, and most parts of it are looking very, very good. Putting the spotlight now on the office market. India's Office Real Estate Investment Trust, also known as, of course, REITs. Their outperformance to the realty index has been quite telling. In fact, we're talking about 15% capital appreciation in 1 year. The key driver has been the underlying strength of India's office real estate market, triggered by heightened demand from GCCs. To talk about this and more, we have with us Somi Thomas, Executive Managing Director, Valuations and Co-Head at Capital Markets India at Cushman & Wakefield, and Vijay Agarwal, Managing Director at Aquarius Capital. Somi and Vijay, thank you very much for being with us. REITs are definitely coming center stage. And I know that because, I'm looking at it from a personal finance angle, just the simple returns are becoming too interesting to ignore right now. But the question is that, is the cycle just starting? Can it continue to be so good? Because it's largely a play on the booming office market. So, Somi, why don't you lay out the ground for us first in terms of just how rentals are moving up? Is it pan-India or is it specific markets, say, in Bengaluru, in Mumbai, which is where this office demand is coming in from?
Thanks, Ravi. I think it's very important to note that most of the office markets across India is doing quite well. It is driven by the GCC demand, the global capability centers. There are headwinds on the IT sector, but we need to really look at the importance of the GCCs for India. So it is most of the GCC market, like you said, Bangalore, Pune, Hyderabad, Chennai, even Gurgaon for that matter, is doing quite well. So the underlying growth on rentals is more than a inflation-adjusted rental growth. So 7 to 8% rental growth we are seeing in most of the core markets of real estate, not necessarily across the outskirts as well, but the core markets. So the talent pool availability is a big factor for GCCs. So they're willing to pay more rental in the preferred micro markets to attract talent. And that's why the rental growth is doing well. And we can see that in the REIT performance, we have a 15% growth in the last 12 months across most of the REITs. And they are doing quite high in occupancy. We have close to 90% occupancy in all the 3 listed REIT, office REITs. Of course, the retail REIT is doing phenomenally well. That's at 97% occupancy.
Somi, just to follow up on REIT returns, and correct me if I'm wrong, I looked at some data, but that was, I think, a month or two back. Average returns can have been ranging in the mid-teens. And, net of tax, they're looking very attractive at a time when the equity market is barely giving you, 10% in a year. Is that sustainable? I mean, what is a realistic expectation to have in terms of IRR when it comes to REITs?
Absolutely. You said it correct. In the today's market, it's a sustainable returns. We are seeing that quite attractive returns because of 3 factors. Like I said, GCCs, supply constraint is still there in the market. The core of the markets, like, for example, BKC in Bombay or Goregaon, Powai, these kind of markets, is difficult to create new supply. So existing tenants are renewing at higher rentals. Like I mentioned, it's very important for these companies to be in the right area to attract the good talent. So we are seeing a mid-teen returns for most of the REITs. And I think with the GCC demand picking up in India, it is quite sustainable.
Gentlemen, morning. Good to have both of you here. Somi, Prashant here. Somi, now, when you look at valuations, right? When should one buy these products? I'm assuming when interest rates are high, right? At the top of the cycle in that sense, right? Yields are high. So you get, there are better pickings. Is that the state we are in right now?
Interest rates obviously are an important factor to give returns, but it's also important to look at the underlying demand factors. We came off at COVID, which created headwinds around the return to office scenario. And even today, maybe some of the developed markets, even in Asia like Japan or Singapore, you probably don't have very good performance in the REIT market. But markets like India, where return to office has become a reality and people want them to come to office for all kinds of reasons, including the new headcount they're adding every year. And they have not met their managers, or they've not really bonded with their colleagues. And innovation and ideas will only happen when you come to office. So we are seeing quite a strong trend of return to offices and a huge demand from the GCC space. So interest rate is one function. Of course, we are already seeing the benefit of interest rates, already reduced by 50 basis points recently.
Somi is, and maybe Vijay can also come in on this if he wants to. It's an asset class which is just about taking off in India, right? I mean, there are 4 listed REITs, 3 are in the commercial space, 1 in the retail space. There is 1 more which is coming. I think Sattva is coming to the market. So it'll be 5, but total market value is $12.5 billion. In the US, for example, it's trillions of dollars. But AI, it's a slightly off-tangent question. If it increases productivity, reduces the need for as many employees, as many seats in the office, fundamentally, where does that leave? Where does it leave things? If either of you wants to take that question briefly.
I think I can take it. I think we have to look at the AI, how AI will impact the demand for office space. I think it can have an impact on the very lower level coding level, not broadly across the. We will not see that the AI will replace human being completely.
No, my point, Vijay, is, of course it will not. But it's like a pyramid, right? Any organization. Yeah. I mean, as you go higher, there are lesser people. The vast majority is the lower end. But if the lower end, as you say, is essentially going to get disrupted, then you don't need as much office space.
Yeah. So we had seen these things when the banks were getting digitized. That time also we had a lot of concern about the manpower, what will happen to the manpower. And if we see our data for 30 years, the banks have increased their manpower strength. So looking at, I think Somi can also chip in here. We don't see.
I'll probably take it. I'll probably take that question in a different manner. Just look at the absorption that Nvidia is doing in India, or there are certain multiple examples of chip companies and AI-driven companies creating India as the most important base, right? So we have seen some of the other large cloud players also increasing their presence in India. So what is really happening, Prashant, from an Indian context is that India is the cornerstone of a strategy for AI for most of these companies. Yeah. The kind of work that is happening has moved completely beyond the call center, the BPO, the low-end coding that Vijay just mentioned. We are talking about doing very high-end R&D work in India.
Sure. So that point is very well taken, that there is demand. GCCs are booming. And, that's showing up in office demand as well. I have a very simple question to you, gentlemen, from an investor perspective. Now, you can either invest in REITs or you can simply buy the underlying stocks. And a lot of these companies have mixed developments. I mean, they've got office developments as well. What could be potentially a better bet, say, over a 3-year period? Vijay, what would you do? Buy the underlying real estate stocks or invest in REITs?
I will take it differently. How is your risk appetite, basically? If you see REITs are a very stable income product and it replaces your bond yields. And suppose if you are looking to invest in a stable return product like a bond, then I would suggest you invest in the REITs because REITs give you a much better return than bond. With the same security, because underlying you have a real estate and real estate value will never go down in India, definitely. So that's the underlying assumption. And you, instead of 7-8% and now 6% with the rate cuts, here you are getting a 12-13% overall return. So I'll suggest to do that, invest in the rates. But if you have a risk appetite, probably you can go for a stock investments in the select real estate development companies which have a mixed portfolio. You can have a Phoenix also, and you can have a Oberoi Realty, and Lota is increasing. So you can play the game. But suppose if you want to buy and forget, then REITs will be the better option. If you see a Nexus REIT, it has given more than 25% return, yearly returns. So that's a fantastic return. You can't get in the stock. And the best part for REITs is that it doesn't go down like a stock market.
That's the thing, and investors are very savvy. They're hearing you say 35% return. They're very quick to, tweak their portfolios where they think there's perhaps other value. And I think REITs are going to become quite a defining product that people will at least look at in the years to come. Thank you very much, gentlemen, for joining in on what is an interesting conversation, a very, very interesting asset class. 35% return in last 1 year, Nigel.
Well, Somi and Vijay have given me some food for thought. We'll do some, analysis on this over the weekend. Thanks a lot, gentlemen, for joining in. Look forward to catching up with you all rather soon. Well, let's move to another corporate then. We have Tata Communications that's on our radar. We have Mr. Lakshmi Narayan, the MD and CEO at Tata Communications, who joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, in the month of June, when you held your analyst meet, you deferred your ambition of doubling your data revenue to around 28,000 crores by FY28. That implies a CAGR of close to around 13%. Now, in Q1, the growth is around 6%. Do you think you get to double digits from next quarter onwards? And for the year, what kind of a number in terms of growth can you deliver? Double digit on the cards?
Yes. Hi, good morning. If you look at our data portfolio, the digital year on year has grown close to 17.4%. which is very good given the macro conditions that we are operating in. The data growth as well year on year has come in just shy of 10%. So we still believe that the macro conditions, there is an effect. There are pricing pressures. The core connectivity particularly has undergone some churn on pricing and some specific SAARC countries related issues that we have had. But these are, we think, are the blips that we have to encounter on the way. But talking about the long-term ambition that we set out, we still very firmly believe that the upsides are very much there, given the areas of investment that we're doing in the digital fabric.
So data revenue growth will return to double digit in the coming quarter?
No, we don't give any guidance. The only markers for us are, since we referred to the Investor Day, we called out that our relevance to our customers are increasing, where we said that our 10 million customers in the last 4 years had doubled. Right? So, and our BFSI segment, where we focused, again, almost doubled in the revenues. So our relevance certainly is increasing. The order book this quarter is better than the previous quarter.
Yes.
Even last year, I had called out both in Q1 and Q2 fairly good order book. That came on the back of some lumpy deals. And Q1 again, we have done quite well in terms of order booking. So and the funnel addition is another good indicator. We have had very good funnel additions both in India as well as in the international market. So I think we feel very, very good about the traction we're getting in the market, the relevance that we see of the portfolio that we have with our customers in their transition journey. These are the two more important factors to me. But the macro is something that we can't control, and therefore I won't be able to give you immediate forecasts on the quarter or the year ahead.
Right, but 28,000 by 2028, you're saying that's the ambition, and you don't think that'll get pushed?
That's very much intact.
Got it. Let's talk about the bright spot then. You mentioned, right, digital revenue, that's done well for you, 17% up, 17.4%. Now you want the share of digital and data revenue to go to 65%. Couple of questions on this front. What's giving you that confidence? When do you get there? And when you're talking about the 65% contribution, are you factoring in some inorganic growth?
No, all of this is
organic.
Organic, yeah.
Okay.
Over the years, all the components of our fabric has significantly strengthened for us, right? So I can talk about each of the fabric, but each of the fabric, whether it's network or the cloud and security or the interaction fabric and the IoT fabric, all of them we have significantly invested and strengthened. The cloud, network and security and the interaction has done very well in the last in this quarter and the last year. The IoT fabric is somewhat muted compared to the past, but all the fabrics, we have complete belief in that would do well. The second aspect of it is some of the new products, that we are working on, and we again called out as some of the strategic bets in our Investor Day. So for example, the whole cloud, the security, where we bundle all the capabilities of CDN, the firewalls, the next generation firewalls, the API security, and all of that. That we believe will be a big uplift. AI Cloud, again, is a big investment. And AI Cloud, particularly combined with our interaction fabric, where we have Kalera AI, where we think that inferencing is going to become more and more important as we go into agentic AI. Our combined value proposition of our own AI Cloud, combined with the agentic AI on top that we provide us in the interaction fabric, will be a great differentiator in the market. So these are some of the bets that we are investing in.
Yeah.
And we think that will get us to the ambition that we have stated.
Sure. So just walk us through what some of these investments and these bets, what they will mean for the margin profile of the company, say for the full year, stepping into next year. Because while in the quarter gone by, your margins improved sequentially, and you were at about 19 odd%. In the past, you were at higher margin levels. You were at 20% plus. So as these investments into AI, agentic AI, all of they continue, does it mean lower margins? I mean, as a trajectory?
Yeah. No, I think, again, in our ambition, we've stated that we will want to get the overall portfolios to be at least at 23%. Our range is 23 to 25. And there are two factors, here. One is in the core connectivity itself. There have been some pricing pressures, and the core connectivity has not grown as much as in the past. So our core connectivity, for the margins to do well, we said it should be in the mid-single digits or low to mid-single digits. That has not happened over the last 2 quarters for various reasons. And one of the primary reasons that we called out is issues in the SAARC countries, and that has muted the core connectivity growth. And that is one big contributor for the overall margin. The second is the overall digital portfolio is negative EBITDA at the moment, and each of the fabrics. So the next-gen connectivity does well. The cloud and security, there are early stages, so we think that will come back into contributing more positively. The interactive.
But by when, sir? So if you could give some time indication, you said your ambition is to get to 23% plus margin.
Right.
By when? And does it get worse before it gets better? I mean, can margins fall to sub 19 as well?
Yeah, the timelines, we again gave out is the medium term of 27, 28. Our first goal in the digital portfolio is to get to an EBITDA neutral position. So today they are all negative. So I don't want to give a specific timeline again, whether it will happen. It will take a few quarters to get there, but the trajectory is the right trajectory that we are moving in.
Got that. Mr. Lakshminarayan, the other sort of question, of course, is every industry is in some way or the other getting more competition or technology disruption, etc., etc. Prashant here, sir. The news this morning, basically, which suggests that, and this is a story from CNBC, that companies like Meta, Google, etc., are laying out, basically subsea cables, tens of thousands of kilometers. I don't know if you've seen that story.
Yes.
That is, in a way, kind of sort of, directly in your line of business. How does it affect you, sir? Is it a bit of a threat?
No.
Competition? Go on.
I don't think it's a competition. It's, our customers who used to lease and buy from us are now investing in their own cable systems. And this cycle is to be expected. So it is not a threat. We are also diversifying into other customers. So, these class of customers we call as the OTT customers who...
Mr. Lakshminarayan, these class of customers, the OTT ones, right? I mean, not what you describe. I mean, I think you describe internally them internally, Meta, Google, etc., as OTT.
Yes.
And this would be how large as a share of your numbers, sir?
No, we don't split that out, Prashant. Both the hyperscalers, the OTTs, and enterprise form the bulk of the core connectivity.
Yeah. So if they are starting to build out their own networks, yeah. I mean, that is essentially problematic, isn't it?
It's not a new phenomenon. It has been happening. Google, AWS, Microsoft, all of them have invested in their own submarine cable systems. It's not a new phenomenon. That has been happening for a while. They also, at the same time, buy from us because they do need diverse paths. The cables get cut under the sea. That's also a phenomenon that is increasing, and that causes resilience issues for these customers. So they do, while they build, they also buy extensively from other parties. So it is not that one is replacing, and their data needs are only growing. It is not coming down. Right?
No, that's the reason why I'm asking, right? I mean, this is the fastest growing part of the business. I mean, not for you, I'm saying generally, if you look at industries, hyper growth in these segments. So, but you're saying that this has been happening, and it's not as if the pace of change is quickening. I mean, it's not if There's no, we're not at a moment where suddenly is going to look very different a year, 2 years down the line.
Not really. I think this phenomenon has been, and the other counterweight to that is the enterprises, especially with their AI. I think their data need and the data growth is going to go exponential. And that also we see. And that is why our focus is on data center to data center connectivity in the enterprise space. And that has been growing very well as well. So I think these movements have always been there. I don't think this is of any particular concern as such. And that is why globally, Prashant, this, the entire area, while it's been coming down in terms of growth, while data growth has been there, pricing pressure brings overall revenue growth down. We have been doing fairly well in that segment with mid-single digit, and we think that we can keep up that growth for the next few years.
Mr. Lakshminarayan, thank you very much, sir. I think your investors would be happy and relieved with you laying that out. Appreciate you joining us here on CNBC TV18 as always. Good luck. We take a quick commercial break here. We're going to focus on one sector, quarter se quarter tak, the next segment, and I think FMCG is in focus. So Mangalam will be here to lay it out for us. Then we'll go across to Amit Purohit from Elara for some perspective. Okay, as promised, it's our special segment, Quarter Se Quarter Tak, where we get you earnings expectations from one sector a day. Mangalam is here with FMCG in the spotlight. Mangalam, morning.
Good morning. So remember the previous quarter, I said the tagline for the sector was same, yet different, because things were looking like they're improving. And this time we go with green shoots are coming. Why do I say that? Because, if you look at it, in the recent times, the stock moves itself showcase that belief. In the month of July so far, the FMCG index has actually outperformed the Nifty by 5%. Even some stocks have rallied in double digits, some for specific reasons and some for good performance. So what's expected this time around? Good rural growth that continues. Urban, which was under pressure, is now seeing gradual improvement, signs of life out there as well. Raw material prices, while they are volatile, the worst seems to be behind them. And staples may outperform discretionary. That's the big headline this time around. Summer products, some of the categories did get impacted by unseasonal rains and strong competition across categories. But we have a peep into what a lot of these companies are likely to report this time around. Godrej Consumer's India business delivered high single-digit value growth driven by mid-single-digit volume growth. Marico said its underlying volume growth in India has been at a multi-quarter high, led by their value-added hair oil business, which grew in low double digits, telling you consumer sentiment has improved because this segment wasn't doing too well for them. Dabur too witnessed sequential recovery in demand with uptick in volume growth in both home and personal care and healthcare. Their beverages portfolio was impacted. There was growth in discretionary. You saw 31% for Kalyan Jewellers, Trent about 20%, 18% for Titan, and V-Mart Retail for 13%. But these stocks actually saw a decline despite optically strong performance coming in the top line. Why? Because the pace of growth slowed down and valuations, they're catching up. So staples doing better than discretionary. Among all the companies that are likely to report numbers this time around, we expect some weakness to continue for Asian paints, even as the environment for the paint sector is improving. HUL, Tata Consumer, Britannia, all of them likely to show incremental improvement. The one particular stock I'll be watching out for this time around, United Breweries, 10 to 12% revenue growth expected. Bears a summer product. The company has increased its focus on premium offerings with all the regulatory navigation that it has to do. That will be important to track. For the entire sector, speaking about strategy, the most important thing will be strategy of new leaders. We have a bevy of new leaders at HUL, Nestle, Pidilite, Titan, Bajaj Consumer, and many more. Further improvement in urban consumption will grow. And finally, scaling up of the recent acquisitions, for instance, HUL having bought Minimalist, etc. And finally, the valuations, all of them pretty close to or slightly below their 5-year average, even after the outperformance that we've seen in July.
Finally, in that valuation table that Mangalam has put up, there's nothing in the 70s. Otherwise, 70s and 80s used to be the norm for the sector. So at least from that standpoint, they've come down. Thank you for that, Mangalam. Let's take the conversation forward. Amit Purohit, Vice President at Elara Securities, is with us to give us how, his whole perspective. Amit, the market is squarely focused on FMCG, bottom of the pyramid consumption, growing, volumes growing. Do you think it can happen in a sustained way? Is this that milestone turnaround quarter for FMCG?
So yeah, thank you for having me. So clearly, I mean, there are some signs which are there with respect to normal monsoon, base effects getting favorable for the sector. I remember last year, second half is when the things got worse, especially companies calling out that urban demand started to slow down quite significantly. And that impact would kind of annualize as we move ahead in the second half of this quarter. This financial year. The second part is obviously the overall hope and expectations of a better monsoon, which will aid into better income growth for the rural and rural growth, which has been talked about, that rural has been growing ahead of urban. That momentum should continue as we expect a normal monsoon this year. And that would ensure that there is no significant downside risk, hopefully, as we move into the second half.
So let's talk some numbers as well. In terms of just the best-in-class growth, like Manglam was just telling us, watch for maybe companies like United Breweries or even Lever, at least mid-single-digit growth. In terms of best growth, what would be the top 2-3 companies that you'll look out for?
So our process is simple. I mean, we look at companies where these segments are building growth for the future. So maybe over a 3 to 4 year perspective, companies who are investing behind that. So these there are 3 important companies which are kind of building up for the future, which I would say. One is Marico, Godrej Consumer, and Tata Consumer. Each of these companies have shown some product innovation or building acquisitions or inorganic growth to build up the growth levers beyond their core categories. So, and most of them, especially like a Marico or a Tata Consumer, a good 25 to 30% of their portfolio will become the growth portfolio, which is growing anywhere between 15 to 20% or even higher. And that would actually provide the necessary engine for growth. So our preference remains on these kind of names. And obviously the other names where the trajectory or the growth has been good, although this quarter seasonally things were not favorable.
Amit, sorry. I'm just going to go focus on the names again. You said Tata Consumer, Marico and Godrej.
Yes.
On a full year basis, what is the growth you're expecting them to deliver? Whether we can talk volume growth or we can talk top line growth as well?
Sure. So Marico would largely be around high single-digit volume growth with double-digit revenue growth, largely driven by price increases that increase in copra prices forcing Marico to take that. This quarter as well, Marico is likely to report 20% plus kind of a growth. For GCPL as well, there is a mid-single-digit volume growth this quarter, and for the full year also we are expecting a mid to high single-digit volume growth with overall growth closer to high to double-digit, low double-digit revenue growth. Tata Consumer again will be a good double-digit revenue growth for this quarter as well as the full financial year effort.
All right, hi Amit, good to see you again. If you have to look for that one earnings surprise this quarter, what would you think? Which stock could that be? Because you have a bit of a cheat sheet that comes out, right? So some part of the results are already known a little bit ahead. But which could be that number that we should really look out for?
So yeah, you're right. I mean, some of the quarterly updates are already out. And I think now more than the revenue growth, the surprise could come somewhere around the margin side is what our sense is that to some extent, Marico or a GCPL, probably if there is any surprise or better than our expectation of the margins, there could be some positive surprise in that. And some outlooks from the companies like Tata Consumer on their growth portfolio or HUVR talking about the outlook going forward and with the recent management change. Some cues on that would probably be some surprises which will play out in the quarterly numbers.
So the thing is, the stocks have also moved higher. I mean, the market's now started positioning for this recovery. So now the final question then, now we've spoken about growth, you map the valuations and the stock run up with it, then which would be your top picks? For instance, if I look at Marico, where you're expecting strong growth, stocks up about 6% so far this month. So again, marry growth and valuations together. And then what are your top picks?
So, I mean, our premise has been for quite some time that companies in FMCG which grow double digit are the ones which will be preferred more over the companies which will have challenges with respect to top line growth. And in that context, I think if I look at Marico, reasonably valued at 46 times FY27, could probably, as we go along and the confidence built up, you would see that this inching up further with respect to the multiples as well is what our sense is. Similar is the story if I look at Godrej Consumer, where the multiple is closer to around 46 times based on our estimate on FY27 basis. And hence, I think these are the companies where you have some uptake in, one, the revenue growth trajectory, and second, as well as some comfort on the valuation as well.
Okay. All right, Amit, interesting conversation. And let's see, because actually these stocks, the Nifty is up hardly 6-7% this year. But some of these stocks where there is a promise or a hope of growth building, they're up. Look at Tata Consumer. I mean, this year it's up almost 20%. Marico is up 13-14%, all outpacing the Nifty already. So interesting times for the consumer space. We'll quickly move on to our 10 a.m. calls. We've got Mitesh back with us. Mitesh, so how do you look at the market now? Again, dealing with a bit of a decline. What are the trades?
So actually, Surabhi, I've been advocating that we might have a stronger chance of heading towards the lower levels, closer to about 24,900 zones. With today's tick, I think the support levels have moved slightly up to about 24,900. I think that's an area where I would explore some long positions on the index. But for the time being, the structure is negative, despite the fact that a lot of stocks are doing good. The advanced decline is also not too bad. What is interesting is that the Bank Nifty is showing first signs of weakness. It opened gap down with that Axis Bank numbers possibly. And since then, the gap has not been filled and we are now heading towards the low of the day. So the Bank Nifty could head towards 156,400, which we are not very far away from. But more realistic target would be around 55,900, which could be tested. So in that sense, a slight negative view on the Bank Nifty would suggest that the Nifty could also be in decline.
Okay, all right. Couple of stocks?
Yeah. I have a buy on Manappuram with a stop at about 270 or maybe 269.5, and look for targets of around 285 over here. And on the sell side is Max Health. Keep a stop at about levels of 1240 and look for targets of around 1185.
Got it. All right. Thanks a lot for that, Mitesh. Just a quick word on Nuvoco. In the first tick itself, we said the stock has run up 10% and it already gained close to around 8%. So maybe bulk of the good news is in the price. Now the stock is up only around 2%. So just keep an eye out on Nuvoco. While the South-based companies, KCP, Sagar, there is that buzz that could be some consolidation out there. Probably with the Deccan Cement. We don't have any confirmation on that. But KCP as well as Sagar Cement, both of them buzzing on very, very high volumes for the first hour of trade. Time to slip into a short break. On the other side, Manisha Gupta will be joining in to help us out with what's going on in the commodity space.
Welcome back. By the way, the equity market's looking a little tentative. We are at the lowest point of the recent trading range. I mean, we've not, in the last many sessions, the Nifty has not breached 25,000, but it's precariously close to that. And it's also fiddling with the 50 DMA as we're speaking. Anyway, let's shift focus to commodities and see if there are brighter headlines over there. Manisha is joining in. Manisha, some of the other commodities always sparkling and bright. Right. So you tell us, what's the news?
Oh, well, yes. Overnight, it clearly has been about platinum and silver. So platinum is trading at a new 14-year highs, but it is silver, and I want to talk about that because this one really seems to be holding quite well. There's a lot of interest into this as well in the Indian markets and globally as well. So we have the prices moving towards $38 an ounce. Since the time it has broken above 30 and 32, we've been looking at it making higher highs into the market. It has been in this week itself that we have seen silver hit a $39 per ounce as a level as well. Remember, this is a fifth straight year of deficit in case of silver. And yes, silver has hit $50 an ounce a couple of times earlier as well. But what really seems to be coming together this time around in sense of fundamentals is very, very strong. So in last 1 month, we've seen prices gain up by 5%. And in this year until now, we are up by nearly 32% in sense of prices there. Also, when you look at the global demand and supply numbers for this year, that tells you that the mismatch itself has been quite supportive. Remember, it's a fifth year of deficit, and in this year as well, we're looking at a demand of 1.05 billion and supplies at 1.2. So you are looking at some concerns coming in there as well. Apart from that, when you look at the overall fundamentals, there is strong investment demand. The ETF demand has been picking up, and the physical buying in sense of bricks and coins also has been on the stronger side. It also has been about strong industrial demand. If there's a switch that goes on and off, there is silver in it. Solar, electronics, electrification, EVs, AIs, semiconductors, you talk about it, laptops, phones, aircrafts, silver usage is only going higher. And the markets do believe that by the time it's 2050, it would be semiconductors and photovoltaic, which would be 55% of overall silver demand. Another interesting point is that there is no resale happening. People are not getting their silver into the market thinking that they can make use of this because they believe that the prices will go higher from here. There is almost absent in sense of profit taking as well, and that has been keeping the prices supportive. This is the other thing, which is the gold and silver ratio. We did hit 101 at the beginning of this year. We are trading at around 87, 85 at this point in time, and that tells you that the silver still has an upside to go. The jewelry used in silver, because the gold prices are trading at an all-time highs, so silver as a substitute there as well seems to be doing quite well. So everywhere that you see, we are looking at stronger fundamentals. Tariffs, geopolitics, gold prices going high, safe haven buying, all of that in turn also has been supportive. And then interestingly, since Russia has said in September 2024 that they are looking to add silver to State Reserve Fund, I mean, this is the first central bank that really seems to be doing that. We've heard of central banks adding gold, but Russia is adding silver to its kitty as well. That has been supportive. And finally, the split tells you on what the markets are believing on where the silver prices could go moving forward from here. JP Morgan talks about 39, a level that we have seen, but they talk about 39 as an average price, so we still have an upside to go. Bank of America, UBS, Standard Chartered, Saxo Bank, everybody has talked about $40 an ounce of a possibility, and as early as the month of August. Interesting report coming in from Citi, where they believe that $40 an ounce for silver will come in 3 months, and they are anticipating $43 in the next 6 to 12 months as well. So bullish cues coming in across from banks and brokerages as well, and fundamentals in any case are quite bullish.
Okay, all right.
Okay, all right, Manisha, thank you very much for that. Well, with that, we do have to take another quick break. On the other side, Lata is in conversation with Mr. Puneet Chhatwal of Indian Hotels. The company's come out with a very, very solid set of numbers for the first quarter. We get an outlook for the rest of the year in just a bit.
Welcome to Corporate Radar. Indian Hotels' first quarter revenue growth has been about 32%. Profit has grown even better by 36.4%. Though these numbers, I must say, are higher partly due to the consolidation of TajSATS. Now, margins at 28.2% also remain very impressive, even if this is a bit less than a year ago, which was at 29%. Also, the company has aggressive expansion plans. And on that note, let me welcome Managing Director and CEO of the company, Mr. Puneet Chhatwal. Mr. Chhatwal, thank you very much indeed for your time, and many congratulations on a day when the market is down, the stock is up, and it's been doing very well. Give us an idea of what is pushing this growth at a time when one would have thought it's a difficult quarter because of Sindoor. You would have lost business in Kashmir. The plane tragedy. In spite of that, it's a good number that you have done, even unconsolidated. What were the top 3 reasons that's working for you?
So, thank you, Lata. The first important reason is the strength of our brandscape. We are not anymore dependent on just one business or one brand. So the diversification of the brandscape and the diversification of the top line is a consequence of that. Number 2 is our asset management initiatives, which we have undertaken since several years. It's an ongoing thing that helps us to drive operating leverage in our capital-heavy portfolio, which is today 40% of the total. And finally, very important are not like for like growth on capital light model. So our management fee income increase, if you see for the quarter, the number that we have used to be the number for the full year 5 years ago. So what we are doing as a management fee income, despite whatever you said, Operation Sindoor, geopolitical tensions, airline tragedy, etc., helps you to drive margins. And the little dip that is in the margin is because of a one-time adjustment we have made in the salary increases. We are giving it as of this year from 1st of April versus 1st of July. So in Q2, Q3, Q4, the increase will be a little lower because it's now divided over a 12-month period.
Okay, actually, your answer is throwing up a lot more questions. I intended to go in a sequence of margins and number of hotels growth. But you spoke about this management light concept or practice. You know, in the investors, after the results, you also spoke about the new Tata Sons platform for investment in select assets. Is that more of the same? That Tata Sons does the construction, you become asset light and earn more management fees? Is that how it will work?
Yes, they would be the owner of the asset, and we would have. We prefer, unless it's a Taj branded property, if it's a Ginger or a Vivanta, we would go for a revenue share model. So we also own the business. And I think it's really geared towards the new businesses and how to support that as another source of capital. And we are very pleased that it's finally happened, this platform, with the first asset coming at the Kolkata airport.
Okay. Well, then let me come to the here and now and then go back to your longer strategy questions. Q2 normally is a weak quarter, isn't it? At least in my community, we don't perform marriages during Ashad. So how is Q2 likely to perform? Can we again get this headline in your press release, 14th consecutive quarter? Will it be like that or will it be different?
We want it to be like that. We don't want that kind of formula to change. So we would like to come back and say this was the best ever Q2. Not just that, what you said, Q4 is the third strongest. We are coming from a sequential basis. And if we look at the weakest, it's always been Q2 in that order. So Q3 is the strongest, Q4 is the second strongest, then you have Q1, and then you have Q2. But the way things are going, there is nothing that makes me feel nervous about Q2 not working out well. On the contrary, I actually feel that again in Q2, especially the international contribution would be very positive, like it has been in Q1 from US and from London. And these are pretty big assets or big sources of revenue. So we remain fairly optimistic about the performance of Q2 also.
Okay. Well, let me come to expansions. You told us in the press release you opened 6 new hotels and signed 12 for this quarter. That would make your portfolio, what, 392, is it?
Absolutely right, Lata. It's impressive.
Okay, no, I just did the numbers now. Now, does this look like then that your 2030 goal will be achieved earlier? You did that with that Avahan, if I remember right. You know, you all did it a year earlier. So your 2030 goals also may happen earlier?
You know, we always say, I can only keep repeating that we promise, we deliver, and in an ideal world, we deliver a bit more than we promised and a little earlier than the deadline that we have given. It has happened twice with Aspiration 2022 and Avant 2025. In an ideal world, Accelerate 2030 should do the same.
Okay. Well, let me come to these other businesses you spoke about. Lately, Taj is not hotels. You all are defining yourselves as, shall I call it, the hospitality ecosystem. You know, you have Amas, you have J Wellness, many, many innovative ideas. Would there be more? Are you all thinking, not for this quarter, not for necessarily only this year, but are there any such concepts that you have in mind?
Absolutely. There are many others that we could do, which have not even come in a significant way in India. One of those, based on my past experience in Europe, is, you know, something like all-inclusive. where you go, you buy a ticket for a flight, and your transfer from home to airport to the hotel and a 1 week stay with the family and coming back has just one price for a family of, let's say, 4. We haven't even gone anywhere close to that as a company, but also as a sector in India. And I think in a few years from now, this will come. Similarly, extended stay is a very important component. It's at a very, very infancy phase in India. So a lot of these new concepts, new businesses, serviced apartments, etc., will come also in a big way as India continues to grow and becomes the 4th largest, or has become the 4th largest economy, and will become the 3rd largest. So all these concepts will also come. And we, being at the forefront of this sector, will obviously try to develop these concepts. Also, belonging to a group that has significant other businesses and can be assisted through whether it's getting, the cars or getting the planes, we stand to benefit a lot from the synergies that a group can offer. So we will always remain open, and any idea that makes sense and is scalable. Very important. We will not do a one-off and stop there. Any idea that is scalable, related to wellness, related to extended stay, related to all-inclusive, and continuous innovation of what you already have, we will try to execute on that relentlessly.
Okay. Well, now let me come to the tougher part of the business. So many hotels, so many ideas would mean rapid training of staff. Are you seeing that as a challenge, both in terms of numbers and cost? Will that be something that will take away from margins or take away from quality?
Firstly, I'm very glad you asked this question. So quality, the test is with institutions that are neutral. I'm sure you read it. Taj was again rated as world's strongest hotel brand and India's strongest brand across all sectors. This is the 4th year in a row, and world's strongest, twice. We have had it in succession, and before that also twice in succession. So that is the proof in terms of the quality. But when it comes to training, it's a very important factor for us. And since last 3 years, we embarked on the journey of upskilling our people at all levels, from an apprentice to management trainee to middle management to the top management, absolute people in the executive committee of the company. We are spending a lot of money in doing that. And more importantly, under our ESG Plus program called Pathya, which just celebrated its 3rd anniversary, we have committed to skill 100,000 people by 2030. And we have achieved the number of 31,000. We've opened 52 skilling centers as part of our CSR contribution, plus our work with Tata Strive, to contribute towards nation building, to contribute towards skill building. And I think all in all, not just for us, we are doing our utmost to contribute to the sector at large, but also the younger population in India, taking them from their rural sectors and skilling them rapidly and making them fit for working in our sector so that they can benefit from our businesses.
Okay. Now, I'll tell you, there are some of your very elite customers who have a different kind of complaint. Because the general upper middle class, the rate of growth of that class is high, its consumption proclivity is probably high. Look at your occupancy. I mean, 75% year after year, quarter after quarter. And I guess in TMPT, in Taj Mahal Towers, you may be going at over 90%. There are your elite customers who say it sometimes looks like a bus stop. It's just that the number of rich are more. So do you even think of a super brand?
Yes and no. So we are always looking at brands, but the Taj Mahal Palace Tower is not just the flagship of the Taj brand, is not just the temple of hospitality, as we affectionately call it. It's a national monument. Yes. People who come to Gateway of India just come in there and just to see the lobby, take their pictures with the flower arrangements. And that's something we have to learn to live with. We cannot just close our doors to the national population, because when there is also something bad happening, like the terror attack is also called the attack on the Taj, right? So it comes with both positives and this kind of challenges. But we are all in all very pleased with such an iconic asset, and the more the people come, the better it is. And some who don't like, we will create a new entrance for them from the back so that they can avoid the traffic if they so want to. These were closed because of that terror attack. It's not that those entrances did not exist before. All the planters that you see in front of the property and the other entrances that were closed were done for security reasons. And we are in conversations with the city and the police to slowly start opening on those.
Okay. No, actually, this is an extremely humane, so very Tata reply that you are giving. I mean, it's something to be appreciated. But actually, I was not referring only to the Taj Mahal Palace and Tower. I mean, generally, there are your very, very elite customers. You know, we get a lot of CEOs. Our daily job is to meet some of the super rich. There is a feeling that, you know, there is a crowd of upper middle class which is now there, and the exclusivity, therefore, in some of your other hotels is lost to them, to this very small sliver. But that discussion another day, out of time, numbers very impressive, and all the very best for the next quarter, Mr. Chhatwal.
Thank you, Lata. Thank you for having me.
Well, that's the word. At least we end on a high note in terms of a company, its performance and its stock price in the green. But otherwise, it's a lot of red on the markets today. Chartbusters will take the action forward after the break.